Introduction to the P/E ratio. 1.1 What is the P/E ratio? The price-to-earnings ratio, commonly referred to as the P/E ratio, is a financial metric used to evaluate the relative value of a company's stock. It is one of the most widely used valuation ratios in the investment community and provides valuable insights into a company's profitability and market perception. The P/E ratio is calculated by dividing the market price per share of a company's stock by its earnings per share (EPS). In simple terms, it represents the amount investors are willing to pay for each dollar of earnings generated by the company. For example, if a company has a P/E ratio of 20, it means investors are willing to pay $20 for every $1 of earnings. The P/E ratio serves as a measure of market sentiment towards a company. It reflects investors' expectations of future growth and profitability. A high P/E ratio suggests that investors have high expectations for the company's future earnings growth, while a low P/E ratio may indicate lower growth expectations or undervaluation. The P/E ratio is often used to compare companies within the same industry or sector. It provides a benchmark for evaluating a company's valuation relative to its peers. Investors can use this ratio to identify companies that are overvalued or undervalued compared to their industry average. There are two types of P/E ratios: trailing P/E ratio and forward P/E ratio. The trailing P/E ratio is calculated using the company's historical earnings over the past 12 months, while the forward P/E ratio uses estimated future earnings. The forward P/E ratio is considered more forward-looking and is often used by investors to assess a company's growth potential. The P/E ratio is a versatile tool that can be used in various investment strategies. Value investors often look for companies with low P/E ratios, as they are considered undervalued and have the potential for future price appreciation. On the other hand, growth investors may be more interested in companies with high P/E ratios, as they indicate strong growth prospects. It is important to note that the P/E ratio should not be used in isolation when making investment decisions. It should be used in conjunction with other financial metrics and qualitative analysis to gain a comprehensive understanding of a company's financial health and prospects. While the P/E ratio is a widely used and valuable tool, it does have its limitations. It does not take into account factors such as a company's debt levels, cash flow, or industry dynamics. Additionally, the P/E ratio can be influenced by market sentiment and investor expectations, which may not always align with a company's true value. In conclusion, the P/E ratio is a fundamental financial metric used to assess the relative value of a company's stock. It provides insights into market sentiment and expectations for future earnings growth. Investors can use the P/E ratio to compare companies within the same industry and identify potential investment opportunities. However, it should be used in conjunction with other financial metrics and qualitative analysis to make informed investment decisions. 1.2 Importance of the P/E ratio. The price-to-earnings ratio, commonly known as the P/E ratio, is a fundamental financial metric used by investors to assess the relative value of a company's stock. It is a simple yet powerful tool that provides valuable insights into a company's earnings potential and market perception. The P/E ratio is widely regarded as one of the most important indicators in stock analysis, and understanding its significance is crucial for investors looking to make informed investment decisions. 1.2.1 Evaluating stock valuation. One of the primary reasons why the P/E ratio is highly regarded is its ability to evaluate stock valuation. By comparing a company's stock price to its earnings per share (EPS), the P/E ratio provides investors with a measure of how much they are willing to pay for each dollar of earnings generated by the company. A high P/E ratio suggests that investors have high expectations for future earnings growth, while a low P/E ratio may indicate undervaluation or lower growth prospects. 1.2.2 Assessing growth potential. The P/E ratio is also a valuable tool for assessing a company's growth potential. A high P/E ratio often indicates that investors have confidence in the company's ability to generate future earnings growth. It suggests that the market expects the company to outperform its peers and deliver strong financial performance in the future. On the other hand, a low P/E ratio may suggest that the market has lower growth expectations for the company. 1.2.3 Comparing companies. Another significant advantage of the P/E ratio is its ability to compare companies within the same industry or across different industries. By comparing the P/E ratios of similar companies, investors can identify potential outliers and determine which companies are overvalued or undervalued relative to their peers. This comparative analysis allows investors to make more informed investment decisions and identify opportunities for potential profit. 1.2.4 Market Sentiment Indicator. The P/E ratio also serves as a valuable indicator of market sentiment. When the overall market is bullish and investor confidence is high, P/E ratios tend to be higher as investors are willing to pay a premium for stocks. Conversely, during bearish market conditions, P/E ratios tend to be lower as investors become more risk-averse and demand higher returns for their investments. Monitoring changes in the P/E ratio can provide insights into market sentiment and help investors gauge the overall market outlook. 1.2.5 Identifying investment opportunities. The P/E ratio can be a useful tool for identifying investment opportunities. By analyzing the P/E ratios of different companies, investors can identify stocks that are trading at a discount or premium relative to their earnings potential. A low P/E ratio may indicate an undervalued stock that has the potential for future growth, while a high P/E ratio may suggest an overvalued stock that may be due for a correction. By identifying these opportunities, investors can make strategic investment decisions and potentially generate higher returns. 1.2.6 Risk Assessment. In addition to evaluating valuation and growth potential, the P/E ratio can also help investors assess the risk associated with a particular stock. A high P/E ratio may indicate that a stock is more susceptible to market volatility and price fluctuations, as investors have higher expectations for future earnings. Conversely, a low P/E ratio may suggest a more stable investment with lower risk. By considering the P/E ratio alongside other risk indicators, investors can make more informed decisions and manage their investment portfolios effectively. 1.2.7 Tracking Performance. The P/E ratio is not only useful for analyzing current stock valuation but also for tracking the performance of a company over time. By comparing a company's current P/E ratio to its historical P/E ratios, investors can identify trends and patterns that may provide insights into the company's financial health and market perception. This historical analysis can help investors make more accurate predictions about future performance and adjust their investment strategies accordingly. In conclusion, the P/E ratio is a vital tool for investors in assessing stock valuation, growth potential, market sentiment, and identifying investment opportunities. It provides valuable insights into a company's earnings potential and market perception, allowing investors to make informed investment decisions. By understanding the importance of the P/E ratio and incorporating it into their investment analysis, investors can enhance their ability to generate favorable returns and manage risk effectively. 1.3 Calculating the P/E ratio. The price-to-earnings P/E ratio is a fundamental financial metric used by investors to assess the relative value of a company's stock. It is a simple yet powerful tool that provides insights into the market's perception of a company's earnings potential and growth prospects. In this section, we will delve into the details of how to calculate the P/E ratio and understand its significance in investment analysis. 1.3.1 The formula for calculating the P/E ratio. The P/E ratio is calculated by dividing the market price per share of a company's stock by its earnings per share (EPS). The formula for calculating the P/E ratio is as follows. P/E ratio equals market price per share, earnings per share. The market price per share is the current trading price of the stock in the market, while the earnings per share is the company's net income divided by the number of outstanding shares. The P/E ratio is expressed as a multiple, indicating how many times the market price per share exceeds the earnings per share. 1.3.2 Example Calculation. Let's consider an example to illustrate the calculation of the P/E ratio. Suppose company XYZ has a market price per share of $50 and an earnings per share of $5. To calculate the P/E ratio, we divide the market price per share by the earnings per share. P/E ratio equals $50 for $5 equals 10. In this example, company XYZ has a P/E ratio of 10, meaning that investors are willing to pay 10 times the company's earnings per share to own its stock. 1.3.3 Interpreting the P/E ratio. The P/E ratio provides valuable insights into the market's expectations for a company's future earnings growth. A high P/E ratio suggests that investors have high expectations for the company's future earnings potential, while a low P/E ratio indicates lower expectations. However, it is important to interpret the P/E ratio in the context of the company's industry and market conditions. A high P/E ratio may indicate that the company is considered a growth stock, with investors willing to pay a premium for its potential future earnings growth. On the other hand, a low P/E ratio may suggest that the company is undervalued or facing challenges that have led to lower market expectations. 1.3.4 Types of P/E ratios. There are two main types of P/E ratios, trailing P/E ratio and forward P/E ratio. The trailing P/E ratio is calculated using the company's historical earnings over the past 12 months. It provides a snapshot of the company's current valuation based on its past performance. The forward P/E ratio, on the other hand, uses analysts' earnings estimates for the next 12 months. It reflects the market's expectations for the company's future earnings growth. Both types of P/E ratios have their merits and limitations. The trailing P/E ratio provides a more concrete assessment of the company's historical performance, while the forward P/E ratio incorporates market expectations for future earnings growth. 1.3.5 Limitations of the P/E ratio. While the P/E ratio is a widely used valuation metric, it is important to recognize its limitations. The P/E ratio does not provide a complete picture of a company's financial health and should not be used in isolation to make investment decisions. Here are some limitations to consider. Earnings quality. The P/E ratio relies on accurate and reliable earnings figures. However, companies can manipulate their earnings through accounting practices, making it crucial to assess the quality and sustainability of earnings. Industry comparisons. Different industries have varying P/E ratio norms due to differences in growth rates, risk profiles, and capital structures. Comparing the P/E ratio of a company in one industry to another may not provide meaningful insights. Cyclical nature. Some industries are cyclical, experiencing periods of high and low earnings. Using the P/E ratio during a peak earnings period may result in an inflated valuation, while using it during a trough earnings period may undervalue the company. Growth expectations. The P/E ratio assumes that future earnings will grow at a consistent rate. However, if a company's growth prospects change significantly, the P/E ratio may not accurately reflect its valuation. Market sentiment. The P/E ratio is influenced by market sentiment and investor perception, which can be subjective and volatile. Changes in market conditions and investor sentiment can impact the P/E ratio, leading to potential misinterpretation. Despite these limitations, the P/E ratio remains a valuable tool in investment analysis when used in conjunction with other financial metrics and qualitative factors. It provides a starting point for understanding a company's valuation and can help investors make informed decisions based on their investment objectives and risk tolerance. In the next section, we will explore the limitations of the P/E ratio in more detail and discuss how to overcome these challenges when analyzing stocks. 1.4 Limitations of the P/E ratio. While the price-to-earnings P/E ratio is a widely used financial metric for evaluating stocks, it is important to recognize its limitations. The P/E ratio provides valuable insights into a company's valuation and market sentiment, but it should not be the sole factor in making investment decisions. In this section, we will explore some of the key limitations of the P/E ratio. 1.4.1 Earnings manipulation. One of the primary limitations of the P/E ratio is that it relies heavily on a company's reported earnings. However, reported earnings can be subject to manipulation by management. Companies may engage in various accounting practices to inflate or deflate their earnings, which can distort the P/E ratio and mislead investors. For example, a company may use aggressive revenue recognition methods or manipulate expenses to artificially boost its earnings. This can result in a lower P/E ratio, making the stock appear undervalued when, in reality, the company's financial health may be questionable. Therefore, investors should exercise caution and conduct thorough due diligence to ensure the accuracy and reliability of a company's reported earnings. 1.4.2 Industry variations. Another limitation of the P/E ratio is that it does not account for industry variations. Different industries have different growth rates, risk profiles, and profitability levels. Comparing the P/E ratios of companies across industries may not provide an accurate assessment of their relative valuations. For instance, technology companies often have higher P/E ratios due to their potential for rapid growth and innovation. On the other hand, mature industries with slower growth rates, such as utilities or consumer staples, tend to have lower P/E ratios. Therefore, it is crucial to consider industry norms and compare a company's P/E ratio to its industry peers to gain a more meaningful understanding of its valuation. 1.4.3 Cyclical nature of earnings. The P/E ratio can be influenced by the cyclical nature of a company's earnings. Some industries, such as construction or automotive, are highly cyclical, experiencing periods of boom and bust. During economic downturns, these companies may face significant declines in earnings, resulting in higher P/E ratios. Conversely, during periods of economic expansion, these companies may experience a surge in earnings, leading to lower P/E ratios. As a result, relying solely on the P/E ratio without considering the underlying business cycle can lead to misleading conclusions about a company's valuation. 1.4.4 Limited perspective on growth. The P/E ratio focuses primarily on a company's current earnings and does not provide a comprehensive view of its growth potential. Companies with high growth prospects may have higher P/E ratios, reflecting the market's expectation of future earnings growth. However, the P/E ratio alone does not capture the full extent of a company's growth opportunities or the risks associated with achieving those growth targets. Investors should consider other factors, such as the company's competitive position, industry trends, and management's ability to execute growth strategies. By incorporating these additional factors, investors can gain a more holistic understanding of a company's growth potential beyond what the P/E ratio indicates. 1.4.5 Lack of consideration for debt. The P/E ratio does not take into account a company's debt levels or its capital structure. Companies with high levels of debt may have lower P/E ratios due to the increased financial risk associated with servicing that debt. Conversely, companies with low debt levels may have higher P/E ratios, as they are perceived to have a lower risk profile. To gain a more accurate assessment of a company's valuation, investors should consider other financial metrics, such as the debt-to-equity ratio or interest coverage ratio, in conjunction with the P/E ratio. This will provide a more comprehensive understanding of a company's financial health and its ability to generate sustainable earnings. 1.4.6 Market sentiment and investor bias. Lastly, the P/E ratio can be influenced by market sentiment and investor bias. During periods of optimism, investors may be willing to pay a premium for stocks, resulting in higher P/E ratios. Conversely, during periods of pessimism or market downturns, investors may be more cautious and demand lower P/E ratios. Additionally, investor biases, such as herd mentality or over-reliance on past performance, can impact the interpretation of the P/E ratio. It is essential for investors to remain objective and consider multiple factors when evaluating a company's valuation, rather than solely relying on the P/E ratio. In conclusion, while the P/E ratio is a valuable tool for evaluating stocks, it has its limitations. Investors should be aware of these limitations and use the P/E ratio in conjunction with other financial metrics and qualitative analysis to make well-informed investment decisions. By considering the broader context and conducting thorough research, investors can mitigate the risks associated with relying solely on the P/E ratio. 2. Historical analysis of the P/E ratio. 2.1 The evolution of the P/E ratio. The price-to-earnings ratio, commonly known as the P/E ratio, is a fundamental financial metric used by investors to assess the relative value of a company's stock. It is a simple yet powerful tool that has been widely used for decades to evaluate investment opportunities. In this section, we will explore the evolution of the P/E ratio and how it has evolved over time. Historical background. The concept of the P/E ratio can be traced back to the early 20th century when Benjamin Graham, widely regarded as the father of value investing, introduced the idea of using earnings multiples to evaluate stocks. Graham believed that the price of a stock should be based on its underlying earnings, and the P/E ratio provided a convenient way to compare the earnings of different companies. Initially, the P/E ratio was calculated using historical earnings data. Investors would look at a company's past earnings and divide the stock price by the average earnings per share over a specific period. This approach provided a snapshot of the company's valuation at a given point in time. Evolution of calculation methods. As financial markets evolved and became more sophisticated, so did the calculation methods for the P/E ratio. With the advent of modern accounting standards and the availability of real-time financial data, investors started using forward-looking earnings estimates to calculate the P/E ratio. Forward P/E ratios became popular because they provided investors with a glimpse into a company's future earnings potential. By using analysts' earnings forecasts, investors could assess whether a stock was overvalued or undervalued based on its expected future earnings. Another variation of the P/E ratio that gained popularity is the trailing P/E ratio. This ratio uses the most recent earnings data available, providing investors with a more up-to-date valuation metric. The trailing P/E ratio is particularly useful for investors who prefer to rely on historical data rather than future projections. Impact of market conditions. The P/E ratio is not a static metric but rather a dynamic one that fluctuates with market conditions. Throughout history, the P/E ratio has shown significant variations, reflecting changes in investor sentiment, economic conditions, and market trends. During periods of economic expansion and bullish market sentiment, the P/E ratio tends to be higher as investors anticipate higher future earnings growth. Conversely, during economic downturns and bearish market conditions, the P/E ratio tends to be lower as investors become more cautious and expect lower future earnings. The dot-com bubble of the late 1990s and early 2000s serves as a prime example of how market conditions can impact the P/E ratio. During this period, investors were willing to pay exorbitant prices for technology stocks based on the expectation of future earnings growth. As a result, the P/E ratios of many technology companies reached unprecedented levels, far exceeding historical norms. However, when the bubble burst, many of these companies experienced significant declines in their stock prices, leading to a sharp contraction in their P/E ratios. Influence of investor behavior. Investor behavior also plays a crucial role in shaping the evolution of the P/E ratio. During periods of market exuberance, investors may exhibit irrational exuberance and bid up stock prices, leading to inflated P/E ratios. Conversely, during periods of market pessimism, investors may become overly cautious and undervalue stocks, resulting in depressed P/E ratios. Psychological biases, such as herd mentality and fear of missing out, can also influence the P/E ratio. When investors see others buying stocks at high P/E ratios, they may feel compelled to do the same, fearing they will miss out on potential gains. This behavior can create a self-reinforcing cycle, driving P/E ratios even higher. Impact of regulatory changes. Regulatory changes can also have a significant impact on the evolution of the P/E ratio. For example, changes in accounting standards can affect how earnings are reported, which in turn can impact the P/E ratio. Additionally, changes in tax laws or government regulations can influence a company's profitability and, consequently, its P/E ratio. The financial crisis of 2008 led to increased scrutiny of financial reporting practices and prompted regulatory reforms aimed at improving transparency and accountability. These reforms had a direct impact on the calculation and interpretation of the P/E ratio, as investors became more cautious and demanded greater accuracy and reliability in financial statements. Conclusion. The P/E ratio has evolved over time, adapting to changes in market conditions, investor behavior, and regulatory requirements. From its humble beginnings as a simple valuation metric, the P/E ratio has become a widely used tool for investors to assess the relative value of stocks. Understanding the evolution of the P/E ratio is essential for investors to make informed investment decisions and navigate the ever-changing landscape of financial markets. 2.2 P/E ratio trends over time. The P/E ratio, also known as the price-to-earnings ratio, is a fundamental financial metric used by investors to assess the valuation of a company's stock. It is calculated by dividing the market price per share by the earnings per share (EPS). The P/E ratio provides insights into how much investors are willing to pay for each dollar of earnings generated by a company. In this section, we will explore the trends of the P/E ratio over time and how it can provide valuable information about the market and individual stocks. By analyzing historical P/E ratios, investors can gain a better understanding of market sentiment, investor expectations, and potential investment opportunities. 2.2.1 Long-term P/E ratio trends. One of the key aspects of analyzing the P/E ratio is to observe its long-term trends. Over time, the P/E ratio tends to fluctuate based on various factors such as economic conditions, market cycles, and investor sentiment. By examining these trends, investors can identify patterns and make informed investment decisions. Historically, the P/E ratio has shown a cyclical pattern. During periods of economic expansion and optimism, the P/E ratio tends to be higher as investors are willing to pay a premium for future earnings growth. Conversely, during economic downturns or periods of market pessimism, the P/E ratio tends to be lower as investors become more risk-averse and demand higher returns. It is important to note that the P/E ratio trends can vary across different industries and sectors. Some industries, such as technology or growth-oriented sectors, may have higher P/E ratios due to their potential for rapid earnings growth. On the other hand, industries that are more mature or cyclical in nature may have lower P/E ratios. 2.2.2 Impact of market cycles on P/E ratios. Market cycles play a significant role in shaping the trends of the P/E ratio. During bull markets, characterized by rising stock prices and positive investor sentiment, the P/E ratio tends to increase as investors anticipate future earnings growth. This can lead to overvaluation of stocks and potentially higher risks for investors. Conversely, during bear markets, characterized by falling stock prices and negative investor sentiment, the P/E ratio tends to decrease as investors become more cautious and demand higher returns. This can create buying opportunities for value investors who seek undervalued stocks with low P/E ratios. Volatile markets, characterized by frequent and significant price fluctuations, can also impact the P/E ratio trends. In times of market volatility, investors may become more uncertain about future earnings prospects, leading to lower P/E ratios. However, it is important to note that volatility can also present opportunities for investors to capitalize on short-term price movements. 2.2.3 Interpreting P/E ratio trends. Interpreting P/E ratio trends requires a comprehensive analysis of various factors. A high P/E ratio may indicate that investors have high expectations for future earnings growth, but it could also suggest overvaluation. Conversely, a low P/E ratio may indicate undervaluation, but it could also reflect poor earnings prospects or market pessimism. Comparing the P/E ratio of a company to its historical average or industry peers can provide additional insights. If a company's P/E ratio is significantly higher or lower than its historical average or industry average, it may indicate a potential investment opportunity or a cause for concern. It is important to consider other financial metrics and qualitative factors when interpreting P/E ratio trends. Factors such as revenue growth, profitability, competitive landscape, and industry dynamics can provide a more holistic view of a company's valuation. 2.2.4 Impact of earnings growth on P/E ratios. Earnings growth is a crucial driver of the P/E ratio. Companies with higher earnings growth potential tend to have higher P/E ratios as investors are willing to pay a premium for future earnings. Conversely, companies with lower earnings growth prospects may have lower P/E ratios. When analyzing P/E ratio trends, it is important to consider the relationship between earnings growth and the P/E ratio. If a company's P/E ratio is increasing while earnings growth is slowing down, it may indicate an overvaluation. Conversely, if a company's P/E ratio is decreasing while earnings growth is accelerating, it may suggest an undervaluation. Investors should also consider the sustainability of earnings growth when interpreting P/E ratio trends. A company with temporary or unsustainable earnings growth may have an inflated P/E ratio, while a company with consistent and reliable earnings growth may have a justified higher P/E ratio. 2.2.5 P/E ratio trends and market sentiment. P/E ratio trends can provide insights into market sentiment and investor expectations. During periods of market optimism, when investors are confident about future earnings growth and economic conditions, P/E ratios tend to be higher. This reflects the willingness of investors to pay a premium for stocks. Conversely, during periods of market pessimism or uncertainty, P/E ratios tend to be lower as investors become more risk-averse and demand higher returns. This can create buying opportunities for value investors who seek undervalued stocks with low P/E ratios. It is important to note that market sentiment can change rapidly, and P/E ratio trends should be analyzed in conjunction with other market indicators and economic factors. By considering a range of factors, investors can gain a more comprehensive understanding of market sentiment and make more informed investment decisions. Conclusion. Analyzing P/E ratio trends over time can provide valuable insights into market dynamics, investor sentiment, and potential investment opportunities. By understanding the long-term patterns and factors influencing P/E ratios, investors can make more informed decisions and navigate the complexities of the stock market. However, it is important to consider the limitations of the P/E ratio and use it in conjunction with other financial metrics and qualitative analysis for a comprehensive investment approach. 2.3 Interpreting historical P/E ratios. The historical analysis of the P/E ratio is a crucial aspect of understanding the valuation of a company or the overall market. By examining the historical trends of the P/E ratio, investors can gain valuable insights into the market's behavior and make informed investment decisions. 2.3.1 The significance of historical P/E ratios. Historical P/E ratios provide a snapshot of how the market has valued a company or the overall market in the past. By analyzing these ratios over a specific time period, investors can identify patterns and trends that can help them assess the current valuation and potential future performance. One of the primary uses of historical P/E ratios is to compare them with the current P/E ratio. This comparison can provide insights into whether a stock or the market is overvalued or undervalued. If the current P/E ratio is significantly higher than the historical average, it may indicate that the stock or the market is overvalued, suggesting caution to investors. Conversely, if the current P/E ratio is lower than the historical average, it may indicate that the stock or the market is undervalued, presenting a potential buying opportunity. 2.3.2 Analyzing historical P/E ratio trends. Analyzing historical P/E ratio trends can help investors understand the market's sentiment towards a particular stock or the overall market. By examining the direction and magnitude of changes in the P/E ratio over time, investors can gain insights into market dynamics and investor expectations. A rising P/E ratio over time may indicate increasing investor optimism and expectations of future earnings growth. This trend suggests that investors are willing to pay a higher premium for each dollar of earnings, reflecting positive market sentiment. Conversely, a declining P/E ratio may indicate deteriorating investor sentiment and expectations of lower future earnings growth. It is important to note that historical P/E ratio trends should be interpreted in conjunction with other fundamental and technical indicators. A rising P/E ratio alone does not guarantee future stock price appreciation, as other factors such as earnings growth, industry trends, and market conditions also play a significant role. 2.3.3 Comparing historical P/E ratios across companies and industries. Comparing historical P/E ratios across companies and industries can provide valuable insights into relative valuations. By examining the P/E ratios of similar companies within an industry or across different industries, investors can identify potential investment opportunities and assess the attractiveness of different sectors. When comparing historical P/E ratios, it is essential to consider the unique characteristics of each industry. Some industries, such as technology or healthcare, may typically have higher P/E ratios due to their growth potential and higher expected earnings growth. On the other hand, industries such as utilities or consumer staples may have lower P/E ratios due to their stable earnings and lower growth prospects. Investors should also consider the company's specific circumstances when comparing historical P/E ratios. Factors such as market position, competitive advantage, and growth prospects can significantly impact a company's valuation and its historical P/E ratio. 2.3.4 Interpreting historical P/E ratios in context. Interpreting historical P/E ratios requires a comprehensive understanding of the company, industry, and broader market conditions. It is crucial to consider the economic and market factors that influence the P/E ratio during the historical period under analysis. For example, during periods of economic expansion and strong market performance, P/E ratios tend to be higher as investors are willing to pay a premium for stocks. Conversely, during economic downturns or market corrections, P/E ratios may decline as investors become more risk-averse and demand lower valuations. Additionally, changes in interest rates, inflation, and government policies can also impact P/E ratios. Lower interest rates and inflation tend to support higher P/E ratios, while higher rates and inflation can put downward pressure on P/E ratios. It is important to note that historical P/E ratios are not foolproof indicators of future performance. They provide a historical perspective and should be used in conjunction with other fundamental and technical analysis tools to make well-informed investment decisions. 2.3.5 Using historical P/E ratios for long-term investing. Long-term investors can utilize historical P/E ratios to identify potential investment opportunities and assess the overall market's valuation. By analyzing the historical P/E ratios of a diversified portfolio of stocks or an index, investors can gain insights into the market's long-term trends and make strategic asset allocation decisions. Historically, periods of low P/E ratios have often been followed by strong market performance, while periods of high P/E ratios have sometimes preceded market downturns. However, it is important to note that historical trends are not guarantees of future performance, and other factors should be considered when making investment decisions. Long-term investors should focus on the underlying fundamentals of the companies they invest in, such as earnings growth, competitive advantage, and management quality. Historical P/E ratios can serve as a reference point to assess the relative valuation of a company or the overall market, but they should not be the sole basis for investment decisions. In conclusion, interpreting historical P/E ratios is a valuable tool for investors to assess the valuation of a company or the overall market. By analyzing trends, comparing ratios across companies and industries, and considering the broader economic and market context, investors can gain insights into market sentiment and make informed investment decisions. However, it is important to use historical P/E ratios in conjunction with other fundamental and technical analysis tools to form a comprehensive investment strategy. 2.4 Case Studies. In this section, we will explore case studies that demonstrate the practical application of P/E ratio analysis in evaluating specific companies. By examining real-world examples, we can gain insights into how the P/E ratio can be used to assess the investment potential of different companies and industries. 2.4.1 Case Study 1, Company A. Company A is a well-established technology company that operates in the software industry. Let's analyze its P/E ratio over the past 5 years to understand its valuation trends and potential investment opportunities. Year earnings per share EPS, stock price P/E ratio 2016 $2.50 $50.20. 2017 $3.60 2018 $3.50 $70 2019 $4.80 2020 $4.50 $90.20. From the case study, we observe that Company A's P/E ratio has remained constant at 20 over the past 5 years. This indicates that investors are willing to pay 20 times the company's earnings for each share of stock. The consistent P/E ratio suggests that the market perceives Company A as a stable and reliable investment. However, it is essential to consider other factors alongside the P/E ratio to make a comprehensive assessment. For instance, analyzing the company's earnings growth rate, competitive position, and industry outlook can provide a more holistic view of its investment potential. 2.4.2 Case Study 2, Company B. Let's now examine Company B, a startup in the renewable energy sector. As a relatively new player in the market, Company B's P/E ratio may provide valuable insights into its growth prospects and market expectations. Year earnings per share EPS, stock price P/E ratio 2016 $50 $10.20. 2017 $75 $15 2018 $1 $20 2019 $1.25 $25 2020 $21.50 $30.20. In this case, we observe that Company B's P/E ratio has also remained constant at 20 over the past 5 years. However, unlike Company A, Company B's earnings per share have been steadily increasing. This suggests that the market has high expectations for the company's future growth potential. Investors may interpret this consistent P/E ratio as an indication that the market believes Company B will continue to deliver strong earnings growth in the future. However, it is crucial to conduct further analysis to assess the company's competitive advantage, market position, and industry dynamics to make an informed investment decision. 2.4.3 Case Study 3, Company C. Let's now turn our attention to Company C, a well-established consumer goods company. By analyzing its P/E ratio, we can gain insights into how market sentiment and industry dynamics impact valuation. Year earnings per share EPS, stock price P/E ratio 2016 $2.40 2017 $2.50 $50 2018 $3.60 2019 $2.50 $50 2020 $22.40 From the case study, we observe that Company C's P/E ratio has remained constant at 20 over the past 5 years. However, the company's earnings per share have fluctuated, indicating potential volatility in its financial performance. This case study highlights the importance of considering other factors alongside the P/E ratio. While the P/E ratio may suggest a stable valuation, investors should delve deeper into the company's financial health, competitive landscape, and market conditions to make an informed investment decision. Lessons learned from case studies. These case studies demonstrate that the P/E ratio is a valuable tool for evaluating companies' investment potential. However, it is crucial to consider other factors such as earnings growth, industry dynamics, and competitive position to make well-informed investment decisions. By analyzing the P/E ratio alongside other financial metrics and qualitative factors, investors can gain a comprehensive understanding of a company's valuation and growth prospects. This holistic approach helps mitigate the limitations of relying solely on the P/E ratio and enhances the accuracy of investment decisions. In the next chapter, we will explore various valuation methods that incorporate the P/E ratio, providing investors with a broader toolkit for assessing investment opportunities. 3. Valuation methods using the P/E ratio. 3.1 Earnings growth and the P/E ratio. The price-to-earnings P/E ratio is a widely used valuation metric in the financial world. It provides investors with a snapshot of how much they are willing to pay for each dollar of earnings generated by a company. While the P/E ratio is a useful tool for evaluating the relative value of a stock, it is important to understand the relationship between earnings growth and the P/E ratio. The basics of earnings growth. Earnings growth refers to the increase in a company's profits over a specific period of time. It is a key indicator of a company's financial health and future prospects. When a company consistently generates higher earnings, it often signals that the business is growing and becoming more profitable. Earnings growth can be driven by various factors, such as increased sales, cost-cutting measures, expansion into new markets, or the introduction of innovative products or services. Investors pay close attention to earnings growth because it directly impacts a company's ability to generate returns for its shareholders. The impact of earnings growth on the P/E ratio. Earnings growth has a significant impact on the P/E ratio. When a company's earnings are growing at a rapid pace, investors are willing to pay a higher price for each dollar of earnings, resulting in a higher P/E ratio. This is because investors expect that the company's future earnings will continue to increase, justifying the higher valuation. On the other hand, if a company's earnings growth is stagnant or declining, investors may be less willing to pay a premium for the stock, leading to a lower P/E ratio. This is because there is less confidence in the company's ability to generate future profits. In general, a high P/E ratio indicates that investors have high expectations for future earnings growth, while a low P/E ratio suggests lower expectations or concerns about the company's future prospects. However, it is important to note that the P/E ratio should not be considered in isolation but rather in conjunction with other financial metrics and qualitative factors. Evaluating earnings growth and the P/E ratio. When evaluating a company's earnings growth and its impact on the P/E ratio, investors should consider several factors. 1. Consistency of earnings growth. Consistency is key when it comes to earnings growth. Investors prefer companies that consistently deliver strong earnings growth over time. A company that has a track record of consistent earnings growth is more likely to command a higher P/E ratio as investors have confidence in its ability to generate future profits. 2. Quality of earnings. The quality of earnings is another important consideration. Investors should assess whether the earnings growth is sustainable and driven by core business operations rather than one-time events or accounting manipulations. Companies with sustainable earnings growth are more likely to maintain a higher P/E ratio. 3. Industry and market conditions. Earnings growth should also be evaluated in the context of the industry and market conditions. Some industries naturally have higher growth rates than others, and market conditions can impact a company's ability to grow its earnings. It is important to compare a company's earnings growth to its peers and consider the overall economic environment. 4. Future growth potential. Investors should also assess a company's future growth potential when considering the impact on the P/E ratio. Factors such as new product launches, expansion into new markets, or strategic partnerships can significantly impact a company's earnings growth prospects. Companies with strong growth potential are more likely to have a higher P/E ratio. Conclusion. Earnings growth plays a crucial role in determining the P/E ratio of a company. Investors should carefully evaluate the consistency and quality of earnings growth, consider industry and market conditions, and assess the future growth potential of a company. By understanding the relationship between earnings growth and the P/E ratio, investors can make more informed investment decisions and identify stocks that offer attractive valuation opportunities. 3.2 Comparing P/E ratios across industries. When analyzing the P/E ratio of a company, it is important to consider how it compares to other companies within the same industry. Comparing P/E ratios across industries can provide valuable insights into the relative valuation of companies and help investors make informed investment decisions. 3.2.1 Understanding industry differences. Different industries have unique characteristics that can significantly impact their P/E ratios. For example, industries with high growth potential, such as technology or biotechnology, often have higher P/E ratios compared to more mature industries like utilities or consumer staples. This is because investors are willing to pay a premium for companies that have the potential for rapid earnings growth. On the other hand, industries that are cyclical in nature, such as automotive or construction, may experience fluctuations in their earnings and, consequently, their P/E ratios. During periods of economic expansion, these industries may have higher P/E ratios as investors anticipate increased earnings. Conversely, during economic downturns, their P/E ratios may be lower due to reduced earnings expectations. It is also important to consider the competitive landscape within each industry. Industries with high barriers to entry, such as pharmaceuticals or telecommunications, may have higher P/E ratios as investors perceive these companies to have a sustainable competitive advantage. Conversely, industries with low barriers to entry, such as retail or hospitality, may have lower P/E ratios due to increased competition and lower profit margins. 3.2.2 Using industry benchmarks. To compare P/E ratios across industries, investors often use industry benchmarks or averages. These benchmarks provide a reference point for evaluating the relative valuation of a company within its industry. By comparing a company's P/E ratio to the industry average, investors can assess whether the company is overvalued or undervalued compared to its peers. Industry benchmarks can be obtained from various sources, including financial websites, industry reports, or investment research firms. These benchmarks are typically calculated based on the P/E ratios of a representative sample of companies within the industry. It is important to ensure that the benchmark used is relevant to the specific industry being analyzed. When comparing a company's P/E ratio to the industry benchmark, there are a few scenarios to consider. P/E ratio higher than industry average. If a company's P/E ratio is higher than the industry average, it may indicate that the company is overvalued relative to its peers. This could be due to factors such as high growth expectations or market optimism. Investors should exercise caution and thoroughly analyze the company's fundamentals before making an investment decision. P/E ratio lower than industry average. If a company's P/E ratio is lower than the industry average, it may suggest that the company is undervalued compared to its peers. This could be due to factors such as low growth expectations or market pessimism. Investors should investigate further to determine if there are any underlying reasons for the lower valuation and assess the company's potential for future growth. P/E ratio in line with industry average. If a company's P/E ratio is similar to the industry average, it indicates that the company is valued in line with its peers. This suggests that the market has priced the company fairly based on its earnings. However, investors should still conduct a thorough analysis of the company's financials and prospects to ensure it aligns with their investment objectives. 3.2.3 Limitations of comparing P/E ratios across industries. While comparing P/E ratios across industries can provide valuable insights, it is important to recognize the limitations of this approach. Here are a few key considerations. Industry differences. Each industry has its own unique characteristics, and comparing P/E ratios across industries may not always be meaningful. Factors such as growth prospects, competitive dynamics, and regulatory environments can vary significantly, making direct comparisons challenging. Accounting practices. Different industries may have different accounting practices, which can impact the calculation of earnings and, consequently, the P/E ratio. It is important to understand the accounting standards and practices specific to each industry when comparing P/E ratios. Cyclical nature. Industries that are cyclical in nature may experience fluctuations in their earnings and P/E ratios. Comparing P/E ratios during different phases of the economic cycle may not provide an accurate representation of the industry's valuation. Company-specific factors. While industry benchmarks provide a useful reference point, it is important to consider company-specific factors when evaluating the P/E ratio. Factors such as the company's competitive position, growth prospects, and management quality can significantly impact its valuation. In conclusion, comparing P/E ratios across industries can be a valuable tool for investors to assess the relative valuation of companies. By understanding industry differences, using industry benchmarks, and considering the limitations of this approach, investors can gain insights into the market's perception of a company's earnings potential. However, it is important to conduct a comprehensive analysis of the company's fundamentals and prospects to make informed investment decisions. 3.3 Using the P/E ratio in relative valuation. In addition to analyzing the P/E ratio of a single company, investors can also use the P/E ratio as a tool for relative valuation. Relative valuation involves comparing the P/E ratio of one company to that of other companies in the same industry or market. This approach allows investors to assess the relative value of a company's stock compared to its peers. 3.3.1 Comparing P/E ratios across industries. One way to use the P/E ratio in relative valuation is by comparing the P/E ratios of companies across different industries. Each industry has its own unique characteristics and growth prospects, which can affect the valuation of its companies. By comparing the P/E ratios of companies within the same industry, investors can gain insights into the relative attractiveness of different sectors. For example, let's consider two companies, Company A technology company, and Company B, a utility company. The P/E ratio of Company A is 25, while the P/E ratio of Company B is 15. At first glance, it may seem that Company A is overvalued compared to Company B. However, when we consider that technology companies generally have higher growth prospects and higher earnings growth rates compared to utility companies, the higher P/E ratio of Company A may be justified. By comparing the P/E ratios of companies across industries, investors can identify sectors that are undervalued or overvalued relative to others. This information can help investors make informed decisions about sector allocation within their portfolios. 3.3.2 Using the P/E ratio in peer group analysis. Another way to use the P/E ratio in relative valuation is by conducting peer group analysis. Peer group analysis involves comparing the P/E ratio of a company to the average P/E ratio of its peer group. A peer group consists of companies that operate in the same industry and have similar business models and market capitalizations. By comparing a company's P/E ratio to its peer group, investors can assess whether the company is trading at a premium or a discount relative to its peers. If a company has a higher P/E ratio than its peer group, it may indicate that the market has higher expectations for its future earnings growth. Conversely, if a company has a lower P/E ratio than its peer group, it may suggest that the market has lower expectations for its future performance. Peer group analysis can provide valuable insights into the relative valuation of a company within its industry. It allows investors to identify companies that may be undervalued or overvalued compared to their peers, which can inform investment decisions. 3.3.3 Using the P/E ratio in cross-industry analysis. In addition to comparing P/E ratios within the same industry, investors can also use the P/E ratio in cross-industry analysis. Cross-industry analysis involves comparing the P/E ratios of companies in different industries to identify relative valuation opportunities. For example, let's consider Company a consumer goods company, and Company C, a healthcare company. The P/E ratio of Company A is 20, while the P/E ratio of Company C is 30. At first glance, it may seem that Company C is overvalued compared to Company A. However, when we consider that healthcare companies generally have higher growth prospects and higher earnings growth rates compared to consumer goods companies, the higher P/E ratio of Company C may be justified. Cross-industry analysis can help investors identify industries that are undervalued or overvalued relative to others. By comparing the P/E ratios of companies in different industries, investors can uncover investment opportunities and make informed decisions about sector allocation. 3.3.4 Limitations of relative valuation using the P/E ratio. While using the P/E ratio in relative valuation can provide valuable insights, it is important to recognize its limitations. The P/E ratio is just one metric among many that investors should consider when assessing the value of a company. Other factors such as growth prospects, competitive advantages, and industry dynamics also play a crucial role in determining a company's valuation. Furthermore, the P/E ratio can be influenced by various factors such as market sentiment, economic conditions, and investor expectations. Therefore, it is important to interpret the P/E ratio in the context of these factors and not rely solely on it for investment decisions. In conclusion, the P/E ratio can be a useful tool in relative valuation. By comparing the P/E ratios of companies within the same industry or across industries, investors can gain insights into the relative attractiveness of different sectors and identify investment opportunities. However, it is important to consider the limitations of the P/E ratio and use it in conjunction with other valuation metrics and qualitative analysis. 3.4 P/E ratio and dividend yield. The price-to-earnings (P/E) ratio is a widely used valuation metric in the financial world. It provides investors with insights into the relative value of a company's stock by comparing its market price to its earnings per share (EPS). While the P/E ratio is primarily used to assess a company's earnings potential, it can also be combined with other financial indicators to gain a more comprehensive understanding of a company's financial health and investment potential. One such indicator is the dividend yield. 3.4.1 Understanding dividend yield. Dividend yield is a financial ratio that measures the annual dividend payment of a company relative to its stock price. It is calculated by dividing the annual dividend per share by the stock's market price. The resulting percentage represents the return on investment an investor can expect to receive from dividends alone. Dividend yield is an important metric for income-oriented investors who seek regular cash flow from their investments. It provides insights into the income-generating potential of a stock and can be compared to other investment options, such as bonds or savings accounts, to assess the relative attractiveness of dividend-paying stocks. 3.4.2 Relationship between P/E ratio and dividend yield. The P/E ratio and dividend yield are two distinct metrics that provide different insights into a company's financial performance. However, they are not mutually exclusive and can be used together to assess the investment potential of a stock. The P/E ratio reflects the market's expectations for a company's future earnings growth. A high P/E ratio suggests that investors have high expectations for future earnings growth, while a low P/E ratio indicates lower growth expectations. On the other hand, dividend yield represents the income generated by a stock through dividend payments. In general, companies with higher P/E ratios tend to have lower dividend yields, as investors are willing to pay a premium for the potential future earnings growth. These companies often reinvest their earnings back into the business to fuel expansion and innovation, rather than distributing them as dividends. On the contrary, companies with lower P/E ratios may have higher dividend yields, as they may have reached a more mature stage in their business cycle and generate stable cash flows that can be distributed to shareholders. 3.4.3 Interpreting P/E ratio and dividend yield. When analyzing the P/E ratio and dividend yield together, it is important to consider the specific characteristics of the company and the industry in which it operates. Different industries have varying norms and expectations regarding dividend payments and earnings growth. For example, technology companies often have higher P/E ratios due to their potential for rapid growth and innovation. These companies may reinvest a significant portion of their earnings into research and development, rather than paying dividends. On the other hand, utility companies, which operate in a stable and regulated industry, tend to have lower P/E ratios and higher dividend yields, as they generate consistent cash flows that can be distributed to shareholders. Investors should also consider the company's dividend policy and its ability to sustain and grow dividend payments over time. A high dividend yield may be attractive, but if the company's earnings are not sufficient to support the dividend payments, it could be a sign of financial instability. Conversely, a low dividend yield may indicate that the company is reinvesting its earnings for future growth, which could be favorable for long-term investors. 3.4.4 Using P/E ratio and dividend yield in investment decisions. The combination of P/E ratio and dividend yield can provide valuable insights for investors when making investment decisions. Here are a few ways in which these metrics can be used. Income-oriented investing. Investors seeking regular income can focus on stocks with higher dividend yields. By considering the P/E ratio alongside dividend yield, investors can assess whether the company's earnings growth potential justifies the dividend payments. Growth and value investing. Investors interested in growth stocks may prioritize companies with higher P/E ratios, as they indicate market expectations for future earnings growth. Conversely, value investors may look for companies with lower P/E ratios and higher dividend yields, as they may be undervalued by the market. Risk management. The combination of P/E ratio and dividend yield can help investors assess the risk associated with a particular stock. A high P/E ratio and low dividend yield may indicate a higher risk investment, as it suggests that the market has high growth expectations without a significant income component. Sector and industry analysis. Comparing the P/E ratios and dividend yields of companies within the same sector or industry can provide insights into the relative attractiveness of different investment options. It can help identify companies that are undervalued or overvalued compared to their peers. Conclusion. The P/E ratio and dividend yield are valuable metrics that provide different perspectives on a company's financial performance and investment potential. While the P/E ratio reflects market expectations for future earnings growth, dividend yield represents the income generated by a stock through dividend payments. By considering these metrics together, investors can gain a more comprehensive understanding of a company's financial health and make more informed investment decisions. However, it is important to consider the specific characteristics of the company and industry when interpreting these metrics and to assess their sustainability over time. 3.5 P/E ratio and market sentiment. Market sentiment plays a crucial role in determining the direction of financial markets. It reflects the overall attitude and emotions of investors towards the market and its various components, including individual stocks. The price-to-earnings P/E ratio, as a widely used valuation metric, is not immune to the influence of market sentiment. In this section, we will explore the relationship between the P/E ratio and market sentiment, and how understanding this connection can provide valuable insights for investors. 3.5.1 The impact of market sentiment on P/E ratios. Market sentiment can have a significant impact on the P/E ratios of individual stocks in the broader market. During periods of optimism and positive market sentiment, investors tend to be more willing to pay higher prices for stocks, leading to an increase in P/E ratios. This can be attributed to the expectation of future earnings growth and a generally positive outlook for the economy. Conversely, during periods of pessimism and negative market sentiment, investors become more risk-averse and may be less willing to pay high prices for stocks. This can result in lower P/E ratios as investors demand a higher earnings yield to compensate for the perceived higher risk. In such situations, the market sentiment can be driven by factors like economic uncertainty, geopolitical tensions, or negative news about specific industries or companies. 3.5.2 P/E ratio is a contrarian indicator. The relationship between market sentiment and the P/E ratio can also be viewed from a contrarian perspective. Contrarian investors believe that market sentiment tends to be overly optimistic during bull markets and overly pessimistic during bear markets. They use this belief to identify potential investment opportunities by going against the prevailing sentiment. When market sentiment is excessively positive, P/E ratios may become inflated as investors bid up stock prices. This can create a situation where stocks are overvalued relative to their earnings potential. Contrarian investors may interpret high P/E ratios during such periods as a signal to exercise caution and consider reducing their exposure to the market. On the other hand, during periods of extreme pessimism and negative market sentiment, P/E ratios may become depressed as investors sell off stocks and prices decline. Contrarian investors may view low P/E ratios as an indication that stocks are undervalued and present buying opportunities. They believe that market sentiment will eventually shift, leading to a potential increase in stock prices and P/E ratios. 3.5.3 Behavioral biases and P/E ratio. Market sentiment is influenced by various behavioral biases that can impact the interpretation of P/E ratios. Two common biases that affect investor decision-making are herd mentality and anchoring bias. Herd mentality refers to the tendency of individuals to follow the actions and opinions of the majority. During periods of extreme market sentiment, such as market bubbles or crashes, herd mentality can lead to a collective overvaluation or undervaluation of stocks. This can result in inflated or depressed P/E ratios that do not accurately reflect the underlying fundamentals of the companies. Anchoring bias occurs when investors rely too heavily on a specific reference point or anchor when making investment decisions. In the context of P/E ratios, investors may anchor their valuation judgments to historical P/E ratios or industry averages without considering the current market conditions or the unique characteristics of the company being analyzed. This can lead to misinterpretation of the P/E ratio and potentially incorrect investment decisions. 3.5.4 Using P/E ratio and market sentiment in combination. To make informed investment decisions, it is essential to consider both the P/E ratio and market sentiment in combination. By analyzing the relationship between the two, investors can gain valuable insights into the market's expectations and potential future trends. For example, if the overall market sentiment is positive, and P/E ratios are high, it may indicate that the market is in a bullish phase, and investors are optimistic about future earnings growth. In such a scenario, investors may need to carefully evaluate whether the high P/E ratios are justified by the company's fundamentals or if they are driven by excessive market exuberance. Conversely, if the market sentiment is negative, and P/E ratios are low, it may suggest that the market is in a bearish phase, and investors are cautious about future earnings prospects. In this case, investors may need to assess whether the low P/E ratios are due to genuine undervaluation or if they reflect justified concerns about the company's financial health or industry headwinds. By combining the analysis of P/E ratios and market sentiment, investors can gain a more comprehensive understanding of the investment landscape. This holistic approach can help identify potential opportunities and risks, enabling investors to make more informed decisions based on a balanced assessment of both quantitative and qualitative factors. In conclusion, market sentiment has a significant influence on the P/E ratios of individual stocks and the broader market. Understanding the relationship between the two can provide valuable insights for investors. By considering market sentiment alongside the P/E ratio, investors can better assess the market's expectations and make more informed investment decisions. However, it is crucial to be aware of the impact of behavioral biases and to conduct thorough analysis to avoid potential pitfalls in interpreting the P/E ratio in the context of market sentiment. 3.6 P/E ratio and economic factors. The price-to-earnings P/E ratio is a widely used financial metric that provides valuable insights into the valuation of a company's stock. While the P/E ratio primarily focuses on the company's earnings and market price, it is also influenced by various economic factors. Understanding the relationship between the P/E ratio and economic factors can help investors make more informed investment decisions. In this section, we will explore some of the key economic factors that can impact the P/E ratio. 3.6.1 Economic growth. Economic growth plays a significant role in determining the P/E ratio of companies. When the economy is experiencing robust growth, companies tend to generate higher earnings, which can lead to an increase in their stock prices. As a result, the P/E ratio of these companies may also rise. Conversely, during periods of economic downturn or recession, companies may face challenges in generating profits, leading to lower stock prices and potentially lower P/E ratios. Investors should consider the overall economic conditions when analyzing the P/E ratio of a company. A growing economy can provide a favorable environment for companies to thrive, leading to higher P/E ratios. On the other hand, a stagnant or contracting economy may result in lower P/E ratios as companies struggle to maintain profitability. 3.6.2 Interest rates. Interest rates have a significant impact on the P/E ratio. When interest rates are low, borrowing costs decrease, making it easier for companies to access capital and invest in growth opportunities. This can lead to higher earnings and potentially higher stock prices, resulting in higher P/E ratios. Conversely, when interest rates are high, borrowing costs increase, which can hinder companies' ability to invest and grow. This may lead to lower earnings and lower stock prices, resulting in lower P/E ratios. Investors should monitor changes in interest rates as they can influence the P/E ratio of companies. A decrease in interest rates can stimulate economic activity and potentially lead to higher P/E ratios. Conversely, an increase in interest rates can have the opposite effect, resulting in lower P/E ratios. 3.6.3 Inflation. Inflation is another economic factor that can impact the P/E ratio. When inflation is high, the purchasing power of consumers decreases, which can lead to lower sales and profitability for companies. This can result in lower stock prices and potentially lower P/E ratios. Conversely, when inflation is low, companies may experience higher sales and profitability, leading to higher stock prices and potentially higher P/E ratios. Investors should consider the inflationary environment when analyzing the P/E ratio of a company. High inflation can erode the value of earnings, leading to lower P/E ratios. On the other hand, low inflation can enhance the value of earnings, potentially resulting in higher P/E ratios. 3.6.4 Government policies and regulations. Government policies and regulations can have a significant impact on the P/E ratio of companies. Changes in tax policies, trade regulations, or industry-specific regulations can affect a company's profitability and growth prospects. For example, tax cuts can increase a company's earnings, potentially leading to higher stock prices and higher P/E ratios. Conversely, increased regulations or taxes can reduce a company's profitability, resulting in lower stock prices and lower P/E ratios. Investors should stay informed about government policies and regulations that may impact the industries or companies they are interested in. Understanding the potential effects of these policies on a company's earnings can help investors assess the P/E ratio more accurately. 3.6.5 Consumer confidence. Consumer confidence is a key economic indicator that can influence the P/E ratio. When consumers are optimistic about the economy and their financial situation, they are more likely to spend, leading to increased sales and profitability for companies. This can result in higher stock prices and potentially higher P/E ratios. Conversely, when consumer confidence is low, consumers may reduce their spending, leading to lower sales and profitability for companies. This can result in lower stock prices and potentially lower P/E ratios. Investors should monitor consumer confidence levels as they can provide insights into the potential future performance of companies. Higher consumer confidence can indicate a favorable environment for companies, potentially leading to higher P/E ratios. Lower consumer confidence, on the other hand, may suggest challenges for companies, potentially resulting in lower P/E ratios. 3.6.6 Global Economic Factors. Global economic factors can also impact the P/E ratio of companies, especially for multinational corporations. Factors such as exchange rates, international trade policies, and geopolitical events can influence a company's earnings and growth prospects. For example, a strong domestic currency can make a company's exports more expensive, potentially reducing its earnings and stock prices, leading to lower P/E ratios. Investors should consider the global economic environment when analyzing the P/E ratio of multinational companies. Understanding the potential impact of global economic factors on a company's earnings can help investors make more informed investment decisions. In conclusion, the P/E ratio is not solely influenced by a company's earnings and market price. Economic factors such as economic growth, interest rates, inflation, government policies, consumer confidence, and global economic factors can all impact the P/E ratio. By considering these economic factors, investors can gain a deeper understanding of the valuation of a company's stock and make more informed investment decisions. 4. Analyzing P/E ratios in different market conditions. 4.1 P/E ratio in bull markets. In this section, we will explore the role of the price-to-earnings P/E ratio in bull markets. A bull market is characterized by a sustained upward trend in stock prices, typically accompanied by investor optimism and positive economic conditions. During these periods, the P/E ratio can provide valuable insights into market sentiment and the valuation of stocks. 4.1.1 Understanding bull markets. Before delving into the P/E ratio's significance in bull markets, it is essential to understand the characteristics of these market conditions. Bull markets are generally driven by strong economic growth, low unemployment rates, and increasing corporate profits. Investor confidence is high, leading to increased demand for stocks and rising prices. During bull markets, investors are often willing to pay a premium for stocks, anticipating future earnings growth and capital appreciation. This optimism can be reflected in the P/E ratio, which measures the price investors are willing to pay for each dollar of earnings generated by a company. 4.1.2 P/E ratio expansion in bull markets. One of the key features of bull markets is the expansion of P/E ratios. As investor optimism grows, they are willing to pay higher prices for stocks, leading to an increase in the P/E ratio. This expansion occurs because investors expect higher future earnings and are willing to pay a premium for the anticipated growth. The P/E ratio expansion in bull markets can be attributed to several factors. Firstly, as economic conditions improve, companies tend to experience higher earnings growth, which positively impacts their P/E ratios. Additionally, low interest rates during bull markets make stocks more attractive compared to fixed income investments, further driving up stock prices and P/E ratios. 4.1.3 Market sentiment and P/E ratio. Market sentiment plays a crucial role in bull markets, and the P/E ratio can act as a barometer of investor sentiment. When investors are optimistic about the future prospects of the economy and individual companies, they are more willing to pay higher prices for stocks, leading to an expansion of P/E ratios. During bull markets, the P/E ratio can become inflated as investor enthusiasm drives stock prices to levels that may not be justified by underlying fundamentals. This situation can create a potential risk of a market bubble, where stock prices become detached from their intrinsic value. Therefore, it is essential for investors to exercise caution and consider other valuation metrics alongside the P/E ratio to make informed investment decisions. 4.1.4 Evaluating P/E ratios in bull markets. While the expansion of P/E ratios in bull markets can indicate positive market sentiment, it is crucial to evaluate these ratios in the context of individual companies and industries. Not all stocks will experience the same level of P/E ratio expansion, and some may even be overvalued. Investors should consider the following factors when evaluating P/E ratios in bull markets. 4.1.4.1 Earnings growth potential. High P/E ratios in bull markets may be justified if the company has strong earnings growth potential. Investors should assess the company's ability to sustain and increase its earnings in the future. A high P/E ratio may be acceptable if the company is expected to deliver above-average earnings growth. 4.1.4.2 Industry comparison. Comparing a company's P/E ratio to its industry peers can provide insights into its relative valuation. If a company's P/E ratio is significantly higher than its industry average, it may indicate that the stock is overvalued. Conversely, a lower P/E ratio relative to the industry average may suggest an undervalued stock. 4.1.4.3 Historical P/E ratios. Analyzing a company's historical P/E ratios can provide valuable context. If the current P/E ratio is significantly higher than the company's historical average, it may indicate an overvalued stock. Conversely, a lower P/E ratio compared to historical levels may suggest an undervalued stock. 4.1.4.4 Fundamental analysis. While the P/E ratio is a useful valuation metric, it should not be the sole basis for investment decisions. Investors should conduct a comprehensive fundamental analysis, considering factors such as revenue growth, profitability, competitive advantage, and management quality. By combining the P/E ratio with other financial indicators, investors can gain a more holistic view of a company's valuation. 4.1.5 Risks and Challenges. Investing in stocks during bull markets can be rewarding, but it also carries risks. The expansion of P/E ratios can lead to overvaluation, making stocks vulnerable to market corrections. Additionally, investor sentiment can change rapidly, and a shift in market sentiment can result in a sharp decline in stock prices. Investors should be cautious of the potential for market bubbles and irrational exuberance during bull markets. It is essential to maintain a disciplined approach to investing, focusing on long-term fundamentals rather than short-term market fluctuations. Conclusion. The P/E ratio plays a significant role in bull markets, reflecting investor optimism and the premium they are willing to pay for stocks. However, investors should exercise caution and consider other valuation metrics and fundamental analysis to make informed investment decisions. By understanding the dynamics of bull markets and evaluating P/E ratios in the context of individual companies, investors can navigate these market conditions more effectively. 4.2 P/E ratio in bear markets. In bear markets, where stock prices are falling and investor sentiment is pessimistic, the P/E ratio can provide valuable insights into the valuation of stocks. The P/E ratio, or price-to-earnings ratio, is a widely used financial metric that compares the price of a stock to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. During bear markets, stock prices tend to decline due to various factors such as economic downturns, geopolitical uncertainties, or negative market sentiment. As a result, the P/E ratio can be a useful tool for investors to assess the relative attractiveness of stocks in such challenging market conditions. 4.2.1 Understanding the P/E ratio in bear markets. In bear markets, the P/E ratio can be influenced by several factors. Firstly, as stock prices decline, the numerator of the P/E ratio, market price per share, decreases, which can lead to a lower P/E ratio. This can make stocks appear more attractive from a valuation perspective, as investors can purchase shares at a lower price relative to the earnings generated by the company. Secondly, during bear markets, earnings of companies may also be impacted negatively. Economic downturns can result in lower corporate profits, which in turn can lead to a decrease in the denominator of the P/E ratio, earnings per share. This can cause the P/E ratio to increase, making stocks appear more expensive. Therefore, it is important for investors to carefully analyze the P/E ratio in bear markets, taking into consideration both the numerator and denominator components. A low P/E ratio may indicate that a stock is undervalued, but it is crucial to assess the sustainability of earnings and the potential for future growth. 4.2.2 Interpreting the P/E ratio in bear markets. When analyzing the P/E ratio in bear markets, it is essential to consider the historical context and compare the current P/E ratio to historical averages. A low P/E ratio relative to historical levels may suggest that stocks are undervalued and present buying opportunities. However, it is important to exercise caution and conduct thorough fundamental analysis to ensure that the low P/E ratio is not a result of deteriorating fundamentals or market uncertainties. Additionally, investors should compare the P/E ratios of different companies within the same industry. This allows for a relative valuation analysis, where stocks with lower P/E ratios compared to their industry peers may be considered more attractive. However, it is crucial to consider the specific circumstances of each company and not solely rely on the P/E ratio as the sole determinant of investment decisions. Furthermore, it is important to note that the P/E ratio alone may not provide a complete picture of a company's valuation in bear markets. Other financial metrics such as price-to-sales ratio, price-to-book ratio, and dividend yield should also be considered to gain a comprehensive understanding of a company's financial health and valuation. 4.2.3 Risks and limitations of the P/E ratio in bear markets. While the P/E ratio can be a valuable tool in bear markets, it is not without its limitations and risks. One of the key limitations is that the P/E ratio is backward-looking and based on historical earnings. In bear markets, where earnings may be declining or uncertain, the P/E ratio may not accurately reflect the future prospects of a company. Additionally, the P/E ratio does not take into account qualitative factors such as management quality, competitive advantages, or industry dynamics. These factors can significantly impact a company's valuation and should be considered alongside the P/E ratio. Moreover, it is important to be cautious of value traps in bear markets. A low P/E ratio may indicate that a stock is undervalued, but it could also be a sign of fundamental issues or deteriorating prospects. Thorough fundamental analysis is crucial to identify stocks that are genuinely undervalued and have the potential for future growth. 4.2.4 Strategies for using the P/E ratio in bear markets. When utilizing the P/E ratio in bear markets, investors can employ several strategies to make informed investment decisions. Contrarian investing. Investors can look for stocks with low P/E ratios relative to historical averages or industry peers. This approach involves identifying companies that are temporarily out of favor but have strong fundamentals and the potential for a turnaround. Quality investing. Instead of solely focusing on the P/E ratio, investors can consider stocks with stable earnings, strong balance sheets, and sustainable competitive advantages. This approach emphasizes the quality of the company rather than just the valuation metric. Sector rotation. Investors can analyze the P/E ratios of different sectors and rotate their investments into sectors that are relatively undervalued. This strategy involves identifying sectors that are less affected by the bear market and have the potential for future growth. Dollar cost averaging. Instead of making a lump sum investment, investors can gradually invest a fixed amount of money at regular intervals. This strategy allows investors to take advantage of market downturns by buying more shares when prices are low, effectively lowering the average cost per share. In conclusion, the P/E ratio can be a valuable tool for investors in bear markets. It provides insights into the relative valuation of stocks and can help identify potential buying opportunities. However, it is important to consider the limitations and risks associated with the P/E ratio and conduct thorough fundamental analysis to make informed investment decisions. 4.3 P/E ratio in volatile markets. In volatile markets, where stock prices experience significant fluctuations and uncertainty, the P/E ratio can provide valuable insights for investors. The P/E ratio, or price-to-earnings ratio, is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It is a measure of how much investors are willing to pay for each dollar of earnings generated by a company. During periods of market volatility, the P/E ratio can be a useful tool for investors to assess the relative value of stocks and make informed investment decisions. Here are some key considerations when analyzing the P/E ratio in volatile markets. 4.3.1 Understanding market volatility. Before delving into the analysis of the P/E ratio in volatile markets, it is important to understand what market volatility entails. Volatility refers to the degree of variation in the price of a financial instrument over time. In volatile markets, stock prices can experience rapid and significant fluctuations, driven by various factors such as economic conditions, geopolitical events, and investor sentiment. 4.3.2 Impact of volatility on P/E ratio. In volatile markets, the P/E ratio can be influenced by the fluctuating stock prices and earnings of companies. When stock prices are highly volatile, the numerator of the P/E ratio, stock price, can change rapidly, leading to fluctuations in the ratio itself. Similarly, earnings can also be affected by market volatility, as companies may experience changes in demand, supply chain disruptions, or other factors that impact their profitability. As a result, the P/E ratio in volatile markets may not provide a stable and reliable measure of valuation. It is important for investors to consider the underlying reasons for the volatility and assess whether it is temporary or indicative of a fundamental change in the company's prospects. 4.3.3 Identifying opportunities in volatile markets. While volatile markets can be challenging, they also present opportunities for investors who are able to navigate the fluctuations and identify undervalued stocks. The P/E ratio can be a valuable tool in this regard, as it allows investors to compare the relative valuations of different companies within the same industry or sector. During periods of market volatility, some companies may experience a decline in their stock prices without a corresponding decline in their earnings. This can result in a lower P/E ratio, indicating that the stock may be undervalued. Investors who are able to identify such opportunities can potentially generate attractive returns when the market stabilizes and the stock price reflects the company's true value. 4.3.4 Risks and challenges. While the P/E ratio can be a useful tool in volatile markets, it is important to recognize its limitations and consider other factors in conjunction with the ratio. Market volatility can be driven by a wide range of factors, and the P/E ratio alone may not provide a comprehensive understanding of a company's prospects. Investors should also be cautious of value traps in volatile markets, where stocks may appear cheap based on their low P/E ratios but are actually facing significant challenges or have poor growth prospects. It is important to conduct thorough research and analysis to assess the underlying fundamentals of a company before making investment decisions. 4.3.5 Long-term perspective. While volatile markets can be unsettling, it is important for investors to maintain a long-term perspective. Market volatility is often temporary, and over the long term, stock prices tend to reflect the underlying fundamentals of companies. The P/E ratio can be a useful tool for identifying opportunities during periods of volatility, but it should be used in conjunction with other valuation metrics and qualitative analysis. Investors should focus on companies with strong fundamentals, sustainable competitive advantages, and a track record of generating consistent earnings growth. By considering these factors alongside the P/E ratio, investors can make more informed investment decisions and navigate the challenges of volatile markets. In conclusion, the P/E ratio can provide valuable insights for investors in volatile markets. While the ratio may fluctuate during periods of market volatility, it can help identify undervalued stocks and opportunities for attractive returns. However, investors should be mindful of the risks and limitations of the P/E ratio and consider other factors in conjunction with the ratio. By maintaining a long-term perspective and conducting thorough research, investors can make informed investment decisions in volatile markets. 4.4 P/E ratio in stable markets. In stable markets, the P/E ratio can provide valuable insights into the overall health and stability of the market. The P/E ratio, or price-to-earnings ratio, is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It is a measure of how much investors are willing to pay for each dollar of earnings generated by a company. 4.4.1 Understanding stable markets. Before delving into the analysis of the P/E ratio in stable markets, it is important to understand what constitutes a stable market. A stable market is characterized by consistent economic growth, low inflation, and minimal fluctuations in interest rates. In such markets, companies tend to experience steady earnings growth, and investors have a higher level of confidence in the overall stability of the market. 4.4.2 P/E ratio and market stability. The P/E ratio can be a useful tool for assessing market stability. In stable markets, the P/E ratio tends to be relatively consistent and predictable. This is because investors have a higher level of confidence in the future earnings potential of companies operating in stable market conditions. As a result, they are willing to pay a premium for these companies, leading to higher P/E ratios. A stable market environment provides a solid foundation for companies to generate consistent earnings. This, in turn, attracts investors who are willing to pay a higher price for the company's stock. As a result, the P/E ratio in stable markets tends to be higher compared to markets with higher levels of uncertainty and volatility. 4.4.3 Interpreting P/E ratio in stable markets. When analyzing the P/E ratio in stable markets, it is important to consider the historical average P/E ratio for the market as a whole. This can provide a benchmark for evaluating individual company P/E ratios. If a company's P/E ratio is significantly higher than the market average, it may indicate that the company is overvalued relative to its peers. Conversely, a lower P/E ratio may suggest that the company is undervalued. It is also important to compare the P/E ratios of companies within the same industry in stable markets. This allows for a more accurate assessment of a company's valuation relative to its competitors. A company with a higher P/E ratio than its industry peers may indicate that investors have higher expectations for its future earnings growth. 4.4.4 P/E ratio and investment strategies in stable markets. The P/E ratio can be a valuable tool for investors in stable markets when it comes to making investment decisions. Here are a few investment strategies that can be employed using the P/E ratio in stable markets. 4.4.4.1 Value investing. Value investors look for companies that are undervalued relative to their intrinsic value. In stable markets, a low P/E ratio compared to the company's historical average or industry peers may indicate that the stock is undervalued. Value investors can use this information to identify potential investment opportunities and take advantage of the market's undervaluation. 4.4.4.2 Dividend investing. Dividend investors focus on companies that pay regular dividends to their shareholders. In stable markets, companies with a stable and consistent dividend history and a reasonable P/E ratio may be attractive to dividend investors. A stable market environment provides a higher level of confidence in the company's ability to sustain its dividend payments. 4.4.4.3 Growth investing. Growth investors seek companies with high growth potential. In stable markets, companies with a high P/E ratio compared to their industry peers may indicate that investors have high expectations for their future earnings growth. Growth investors can use this information to identify companies that are expected to outperform their competitors and generate above-average returns. Conclusion. In stable markets, the P/E ratio can provide valuable insights into the overall health and stability of the market. It can help investors assess the valuation of individual companies and make informed investment decisions. By comparing a company's P/E ratio to historical averages and industry peers, investors can identify potential opportunities and avoid overvalued stocks. However, it is important to consider other factors such as earnings growth, industry trends, and market conditions when using the P/E ratio as a valuation tool. 5. Using the P/E ratio for investment decisions. 5.1 P/E ratio and stock selection. When it comes to investing in stocks, one of the most commonly used valuation metrics is the price-to-earnings P/E ratio. The P/E ratio is a simple yet powerful tool that can help investors assess the relative value of a stock and make informed decisions about stock selection. In this section, we will explore how the P/E ratio can be used as a tool for stock selection and provide insights into its strengths and limitations. 5.1.1 Understanding the P/E ratio. Before delving into the role of the P/E ratio in stock selection, it is important to have a clear understanding of what the ratio represents. The P/E ratio is calculated by dividing the market price per share of a stock by its earnings per share (EPS). It essentially tells us how much investors are willing to pay for each dollar of earnings generated by the company. A high P/E ratio suggests that investors have high expectations for future earnings growth, while a low P/E ratio may indicate that the market has lower expectations. However, it is crucial to note that the interpretation of the P/E ratio should not be done in isolation. It is essential to consider other factors such as industry norms, growth prospects, and the company's competitive position. 5.1.2 Using the P/E ratio for stock selection. The P/E ratio can be a valuable tool for stock selection as it provides insights into the market's perception of a company's earnings potential. Here are some ways in which the P/E ratio can be used in stock selection. 5.1.2.1 Comparing P/E ratios across companies. One of the primary uses of the P/E ratio is to compare the valuation of different companies within the same industry. By comparing the P/E ratios of companies operating in the same sector, investors can identify potential outliers and gain insights into which companies are overvalued or undervalued relative to their peers. For example, if Company A has a P/E ratio of 20 and Company B has a P/E ratio of 15, it suggests that investors are willing to pay a higher premium for the earnings of Company A. This could indicate that Company A is perceived to have better growth prospects or a stronger competitive advantage. 5.1.2.2 Identifying undervalued or overvalued stocks. The P/E ratio can also be used to identify stocks that may be undervalued or overvalued in the market. A low P/E ratio relative to the company's historical average or the industry average may suggest that the stock is undervalued and may present a buying opportunity. Conversely, a high P/E ratio may indicate that the stock is overvalued and may be due for a correction. However, it is important to exercise caution when using the P/E ratio as a standalone indicator of value. Other factors such as the company's growth prospects, competitive position, and industry dynamics should also be considered to make a well-informed investment decision. 5.1.2.3 Assessing growth potential. The P/E ratio can provide insights into a company's growth potential. A high P/E ratio may indicate that investors have high expectations for future earnings growth, while a low P/E ratio may suggest that the market has lower growth expectations. Investors looking for growth stocks may prefer companies with higher P/E ratios, as they are willing to pay a premium for the potential future earnings growth. On the other hand, value investors may seek out stocks with lower P/E ratios, as they believe the market has undervalued the company's growth prospects. 5.1.3 Limitations of the P/E ratio in stock selection. While the P/E ratio can be a useful tool for stock selection, it is important to recognize its limitations. Here are some key limitations to consider. 5.1.3.1 Industry variations. Different industries have different norms and dynamics that can impact the interpretation of the P/E ratio. For example, technology companies often have higher P/E ratios due to their potential for rapid growth, while utility companies may have lower P/E ratios due to their stable but slower growth nature. It is crucial to compare the P/E ratios of companies within the same industry to gain meaningful insights. 5.1.3.2 Earnings quality. The P/E ratio is based on reported earnings, which may not always reflect the true earnings potential of a company. Companies can manipulate their earnings through accounting practices, making it important to assess the quality and sustainability of earnings before relying solely on the P/E ratio for stock selection. 5.1.3.3 Cyclical nature of businesses. Certain industries are more cyclical in nature, experiencing periods of high growth followed by downturns. The P/E ratio may not accurately capture the earnings potential during different phases of the business cycle. Investors should consider the specific dynamics of the industry and the stage of the business cycle when interpreting the P/E ratio. Conclusion. The P/E ratio is a valuable tool for stock selection, providing insights into the market's perception of a company's earnings potential. By comparing P/E ratios across companies, identifying undervalued or overvalued stocks, and assessing growth potential, investors can make more informed investment decisions. However, it is important to consider the limitations of the P/E ratio and use it in conjunction with other fundamental and qualitative analysis to make well-rounded investment choices. 5.2 P/E ratio and market timing. Market timing is a strategy that involves attempting to predict the future movements of the stock market in order to make investment decisions. It is based on the belief that by accurately predicting when to buy and sell stocks, investors can maximize their returns and minimize their risks. The P/E ratio, or price-to-earnings ratio, is a commonly used valuation metric that can be helpful in market timing. 5.2.1 Understanding market timing. Market timing is a challenging strategy to execute successfully. It requires accurately predicting the direction of the market, which is notoriously difficult to do consistently. Many investors have tried and failed to time the market, often resulting in poor investment performance. The goal of market timing is to buy stocks when the market is expected to rise and sell stocks when the market is expected to decline. This strategy is based on the belief that stock prices tend to move in cycles, with periods of growth followed by periods of decline. By identifying these cycles and making timely investment decisions, investors hope to generate higher returns and avoid losses. 5.2.2 The role of the P/E ratio in market timing. The P/E ratio can be a useful tool in market timing because it provides insights into the valuation of stocks. The ratio compares the price of a stock to its earnings per share (EPS), indicating how much investors are willing to pay for each dollar of earnings. A high P/E ratio suggests that investors have high expectations for future earnings growth, while a low P/E ratio may indicate undervaluation or lower growth expectations. When market timing, investors often look for opportunities to buy stocks when their P/E ratios are low and sell when their P/E ratios are high. The rationale behind this approach is that stocks with low P/E ratios may be undervalued and have the potential for future price appreciation, while stocks with high P/E ratios may be overvalued and at risk of a price correction. 5.2.3 Using the P/E ratio for market timing. To use the P/E ratio for market timing, investors need to analyze the historical trends and current levels of the ratio. By comparing the current P/E ratio of the overall market or specific stocks to their historical averages, investors can gain insights into whether the market is overvalued or undervalued. If the P/E ratio of the market or a particular stock is significantly higher than its historical average, it may indicate that the market is overvalued and a correction could be imminent. In this case, investors may consider reducing their exposure to stocks or even selling their holdings to lock in profits. Conversely, if the P/E ratio is significantly lower than its historical average, it may suggest that the market is undervalued and poised for a potential rally. Investors may consider increasing their exposure to stocks or buying undervalued stocks to take advantage of the expected price appreciation. It is important to note that market timing based solely on the P/E ratio can be challenging and risky. The P/E ratio is just one of many factors that influence stock prices, and it does not guarantee accurate market predictions. Other factors such as economic conditions, company fundamentals, and market sentiment also play significant roles in determining stock market movements. 5.2.4 Limitations and risks of market timing with the P/E ratio. Market timing using the P/E ratio is not without its limitations and risks. Firstly, accurately predicting market movements based on the P/E ratio alone is extremely difficult. The stock market is influenced by a multitude of factors, including economic indicators, geopolitical events, and investor sentiment, which can make it unpredictable. Secondly, the P/E ratio can be influenced by temporary factors that may not accurately reflect the long-term value of a stock. For example, a company may experience a temporary decline in earnings due to a one-time event, causing its P/E ratio to appear higher than usual. In such cases, relying solely on the P/E ratio for market timing may lead to erroneous investment decisions. Lastly, market timing requires frequent buying and selling of stocks, which can result in higher transaction costs and potential tax implications. Additionally, frequent trading increases the risk of making emotional investment decisions based on short-term market fluctuations rather than long-term fundamentals. 5.2.5 The importance of a long-term perspective. While market timing using the P/E ratio can be tempting, it is important for investors to maintain a long-term perspective. Trying to time the market consistently is challenging and often leads to suboptimal investment outcomes. Instead, investors should focus on building a well-diversified portfolio of high-quality stocks and holding them for the long term. By taking a long-term approach, investors can benefit from the power of compounding and ride out short-term market fluctuations. Rather than trying to predict short-term market movements, investors should focus on identifying fundamentally strong companies with sustainable earnings growth potential. In conclusion, the P/E ratio can provide valuable insights for market timing, but it should not be the sole basis for investment decisions. Market timing is a challenging strategy that requires accurate predictions of market movements, which is difficult to achieve consistently. Investors should approach market timing with caution and maintain a long-term perspective to achieve their investment goals. 5.3 P/E ratio and portfolio allocation. When it comes to investing, one of the key considerations is how to allocate your portfolio across different assets. The P/E ratio, or price-to-earnings ratio, can be a valuable tool in determining the optimal allocation strategy. By understanding the relationship between the P/E ratio and portfolio allocation, investors can make informed decisions about where to allocate their capital. 5.3.1 P/E ratio and asset classes. The P/E ratio can provide valuable insights into the relative valuation of different asset classes. It is commonly used in the analysis of stocks, but it can also be applied to other asset classes such as bonds, real estate investment trusts, REITs, and exchange-traded funds (ETFs). In the context of portfolio allocation, the P/E ratio can help investors determine which asset classes are overvalued or undervalued relative to historical norms. For example, if the P/E ratio of stocks is significantly higher than its historical average, it may indicate that stocks are overvalued and that it may be prudent to reduce exposure to equities and consider alternative asset classes. Conversely, if the P/E ratio of a particular asset class is lower than its historical average, it may suggest that the asset class is undervalued and may present an attractive investment opportunity. In such cases, investors may consider increasing their allocation to that asset class to take advantage of potential future price appreciation. 5.3.2 P/E ratio and diversification. Diversification is a fundamental principle of portfolio allocation, aimed at reducing risk by spreading investments across different asset classes. The P/E ratio can play a crucial role in achieving diversification by helping investors identify assets with different valuation characteristics. By analyzing the P/E ratios of various asset classes, investors can identify assets that have low or negative correlations with each other. This means that when one asset class is performing poorly, another asset class may be performing well, helping to offset losses and stabilize the overall portfolio. For example, during periods of economic downturn, stocks may experience a decline in their P/E ratios as earnings decrease. At the same time, bonds may become more attractive as investors seek safer investments. By allocating a portion of the portfolio to bonds, investors can potentially reduce the overall volatility of their portfolio during market downturns. 5.3.3 P/E ratio and risk-return trade-off. The P/E ratio can also help investors assess the risk-return trade-off of different asset classes. Generally, assets with higher P/E ratios are considered riskier, as they imply higher expectations for future earnings growth. On the other hand, assets with lower P/E ratios are often perceived as less risky, as they may indicate lower growth expectations or undervaluation. When constructing a portfolio, investors need to strike a balance between risk and return. By considering the P/E ratios of different asset classes, investors can make more informed decisions about how to allocate their capital to achieve their desired risk-return profile. For example, if an investor has a higher risk tolerance and is seeking higher potential returns, they may choose to allocate a larger portion of their portfolio to assets with higher P/E ratios, such as growth stocks. Conversely, if an investor has a lower risk tolerance and prioritizes capital preservation, they may opt for assets with lower P/E ratios, such as value stocks or bonds. 5.3.4 P/E ratio and rebalancing. Portfolio rebalancing is an essential practice to maintain the desired asset allocation over time. The P/E ratio can provide valuable insights into when and how to rebalance a portfolio. When the P/E ratio of a particular asset class deviates significantly from its historical average, it may indicate that the asset class is either overvalued or undervalued. In such cases, investors may consider rebalancing their portfolio by selling or buying assets to bring the allocation back in line with their target weights. For example, if the P/E ratio of stocks has increased significantly and is above its historical average, it may suggest that stocks are overvalued. In this scenario, investors may choose to sell some of their stock holdings and reallocate the proceeds to other asset classes with more attractive valuations. On the other hand, if the P/E ratio of a particular asset class is significantly lower than its historical average, it may indicate that the asset class is undervalued. In this case, investors may consider increasing their allocation to that asset class by buying more shares or units. 5.3.5 P/E ratio and long-term investing. The P/E ratio can be particularly useful for long-term investors who have a time horizon of several years or more. By analyzing the P/E ratios of different asset classes over extended periods, investors can identify trends and make informed decisions about long-term portfolio allocation. Long-term investors can use the P/E ratio to identify assets that have historically provided attractive returns and have the potential for future growth. By allocating a significant portion of their portfolio to such assets, investors can position themselves to benefit from long-term capital appreciation. However, it is important to note that the P/E ratio should not be the sole determinant of portfolio allocation decisions. Other factors, such as the investor's risk tolerance, investment goals, and market conditions, should also be taken into consideration. In conclusion, the P/E ratio can be a valuable tool for portfolio allocation. By considering the P/E ratios of different asset classes, investors can identify undervalued or overvalued assets, achieve diversification, assess the risk-return trade-off, and make informed decisions about rebalancing their portfolio. However, it is crucial to use the P/E ratio in conjunction with other fundamental and technical analysis tools to make well-rounded investment decisions. 5.4 P/E ratio and risk management. Risk management is a crucial aspect of investing, and the P/E ratio can play a significant role in assessing and managing investment risks. The P/E ratio provides valuable insights into the market's perception of a company's future earnings potential and can help investors gauge the level of risk associated with a particular investment. In this section, we will explore how the P/E ratio can be used as a tool for risk management and discuss its limitations in this context. 5.4.1 Assessing risk with the P/E ratio. The P/E ratio can be used as an indicator of the market's expectations for a company's future earnings growth. A high P/E ratio suggests that investors have high expectations for the company's future earnings, while a low P/E ratio may indicate lower growth expectations or potential risks. By analyzing the P/E ratio, investors can gain insights into the perceived risk associated with a particular investment. When evaluating the risk of an investment using the P/E ratio, it is essential to consider the industry and market conditions. Different industries may have different average P/E ratios due to variations in growth rates, profitability, and risk profiles. Comparing a company's P/E ratio to its industry peers can provide a better understanding of its relative risk level. A significantly higher or lower P/E ratio than the industry average may indicate higher or lower risk, respectively. Additionally, the P/E ratio can be used to assess the risk of investing in different market conditions. During periods of economic uncertainty or market volatility, investors may be more cautious and demand a higher risk premium. As a result, P/E ratios may contract, indicating higher perceived risk. Conversely, in stable or bullish market conditions, investors may be more optimistic, leading to higher P/E ratios and potentially lower perceived risk. 5.4.2 Limitations of the P/E ratio in risk management. While the P/E ratio can provide valuable insights into investment risk, it is important to recognize its limitations. The P/E ratio is a backward-looking metric that relies on historical earnings data. It does not capture future uncertainties or potential changes in a company's earnings prospects. Therefore, it should not be the sole determinant of investment decisions. Moreover, the P/E ratio does not consider other risk factors such as industry-specific risks, competitive landscape, management quality, or macroeconomic conditions. Investors should consider these factors in conjunction with the P/E ratio to make well-informed investment decisions. Another limitation of the P/E ratio is its susceptibility to manipulation. Companies can manipulate earnings to artificially inflate or deflate the P/E ratio, making it challenging to assess the true risk associated with an investment. Investors should conduct thorough due diligence and consider other financial metrics to validate the P/E ratio's accuracy. Furthermore, the P/E ratio may not be suitable for evaluating companies in certain sectors or industries. For example, high-growth technology companies often have high P/E ratios due to their potential for future earnings growth. However, these companies may also carry higher risk due to their reliance on innovation, market competition, and regulatory challenges. In such cases, investors should consider using alternative valuation metrics or industry-specific benchmarks to assess risk. 5.4.3 Using the P/E ratio in risk mitigation strategies. Despite its limitations, the P/E ratio can still be a valuable tool in risk management strategies. Here are a few ways investors can incorporate the P/E ratio into their risk mitigation strategies. Diversification. By analyzing the P/E ratios of different companies within a portfolio, investors can identify potential concentration risks. A well-diversified portfolio with a mix of low, moderate, and high P/E ratio stocks can help mitigate the impact of individual stock volatility. Contrarian investing. Contrarian investors often look for opportunities in stocks with low P/E ratios. These stocks may be undervalued or facing temporary challenges, but the low P/E ratio can provide a margin of safety and potentially limit downside risk. Risk-adjusted return analysis. Investors can use the P/E ratio as part of a risk-adjusted return analysis to assess the potential return relative to the perceived risk. By comparing the P/E ratio of a stock to its expected earnings growth rate, investors can evaluate whether the stock is priced attractively considering its risk profile. Monitoring P/E ratio trends. Tracking the P/E ratio trends of individual stocks or the overall market can help investors identify potential shifts in risk sentiment. Rapid changes in P/E ratios may indicate changing market dynamics or emerging risks that warrant closer attention. Combining P/E ratio with other metrics. To gain a more comprehensive understanding of investment risk, investors should consider combining the P/E ratio with other financial metrics such as debt levels, cash flow, and return on equity. This multidimensional analysis can provide a more holistic view of the risk associated with an investment. In conclusion, the P/E ratio can be a valuable tool for risk management in investment decision-making. It provides insights into market expectations and can help investors assess the perceived risk associated with a particular investment. However, it is crucial to consider the limitations of the P/E ratio and incorporate other risk factors and financial metrics to make well-informed investment decisions. 6. Common pitfalls in P/E ratio analysis. 6.1 Ignoring industry norms. When analyzing the P/E ratio of a company, it is crucial to consider industry norms and benchmarks. Ignoring industry norms can lead to inaccurate interpretations and misjudgments of a company's valuation. The P/E ratio is a relative valuation metric that compares a company's stock price to its earnings per share (EPS). It provides insights into how the market values a company's earnings. Each industry has its own unique characteristics, growth rates, and risk profiles. Therefore, the P/E ratio can vary significantly across different sectors. Ignoring these industry norms can result in misleading conclusions about a company's valuation. To effectively analyze the P/E ratio, it is essential to compare it to the average P/E ratio of companies within the same industry. 6.1.1 Importance of industry comparisons. By comparing a company's P/E ratio to the industry average, investors can gain a better understanding of whether the company is overvalued or undervalued relative to its peers. A high P/E ratio compared to the industry average may indicate that the company is expected to have higher future growth prospects or that investors have high expectations for its performance. Conversely, a low P/E ratio compared to the industry average may suggest that the company is undervalued or facing challenges. Industry comparisons also help investors identify outliers within a sector. If a company's P/E ratio deviates significantly from the industry average, it may be a sign of unique circumstances or opportunities that warrant further investigation. For example, a company with a lower P/E ratio than its competitors may have a competitive advantage or be undervalued due to temporary market conditions. 6.1.2 Factors affecting industry norms. Several factors can influence industry norms and the average P/E ratio within a sector. These factors include 6.1.2.1 Growth prospects. Industries with higher growth prospects tend to have higher P/E ratios. Investors are willing to pay a premium for companies in sectors expected to experience rapid growth. On the other hand, industries with slower growth rates may have lower P/E ratios as investors demand a lower premium for their investments. 6.1.2.2 Risk Profile. Industries with higher risk profiles, such as technology or biotechnology, often have higher P/E ratios. These industries are characterized by higher volatility and uncertainty, leading investors to demand a higher return on their investments. Conversely, industries with lower risk profiles, such as utilities or consumer staples, tend to have lower P/E ratios as investors seek more stable and predictable returns. 6.1.2.3 Economic conditions. Economic conditions can also impact industry norms and the average P/E ratio. During periods of economic expansion and optimism, investors may be willing to pay higher multiples for companies, resulting in higher industry P/E ratios. Conversely, during economic downturns or periods of uncertainty, investors may be more cautious and demand lower multiples, leading to lower industry P/E ratios. 6.1.3 Benefits of considering industry norms. By considering industry norms when analyzing the P/E ratio, investors can 6.1.3.1 Identify overvalued or undervalued companies. Comparing a company's P/E ratio to the industry average allows investors to identify companies that may be overvalued or undervalued. If a company's P/E ratio is significantly higher than the industry average, it may indicate that the stock is overvalued and may be due for a correction. Conversely, if a company's P/E ratio is significantly lower than the industry average, it may suggest that the stock is undervalued and may present a buying opportunity. 6.1.3.2 Assess growth potential. Industry norms provide a benchmark for assessing a company's growth potential. If a company's P/E ratio is higher than the industry average, it may indicate that the market expects the company to outperform its peers and achieve higher growth rates. Conversely, if a company's P/E ratio is lower than the industry average, it may suggest that the market has lower growth expectations for the company. 6.1.3.3 Manage risk. Considering industry norms helps investors manage risk by providing a broader context for evaluating a company's valuation. By understanding the average P/E ratio within an industry, investors can assess whether a company's valuation is in line with its peers or if there are unique factors driving its valuation. This information can help investors make more informed decisions and mitigate the risk of overpaying for a stock. 6.1.4 Limitations of industry comparisons. While industry comparisons are valuable, it is important to recognize their limitations. Industries can be diverse, and not all companies within a sector have the same growth prospects, risk profiles, or financial performance. Therefore, it is essential to consider other fundamental factors, such as a company's financial health, competitive position, and management quality, in conjunction with the P/E ratio and industry norms. Additionally, industry norms can change over time due to shifts in market dynamics, technological advancements, or regulatory changes. Therefore, it is crucial to regularly update industry benchmarks and reassess the relevance of historical industry norms. Ignoring industry norms when analyzing the P/E ratio can lead to flawed investment decisions. By considering industry benchmarks, investors can gain a more accurate understanding of a company's valuation relative to its peers and make more informed investment choices. 6.2 Over-reliance on P/E ratio. The price-to-earnings P/E ratio is a widely used financial metric that provides investors with valuable insights into a company's valuation. It is calculated by dividing the market price per share by the earnings per share. The P/E ratio is often used as a quick and convenient way to assess whether a stock is overvalued or undervalued. However, it is important for investors to recognize the limitations of the P/E ratio and avoid over-reliance on this single metric when making investment decisions. 6.2.1 Understanding the limitations. While the P/E ratio can be a useful tool, it is crucial to understand its limitations. One of the main limitations is that the P/E ratio does not take into account the future growth prospects of a company. It is a backward-looking metric that is based on historical earnings. Therefore, it may not accurately reflect the true value of a company, especially if the company is in a high-growth phase. Another limitation of the P/E ratio is that it does not consider the industry or sector in which a company operates. Different industries have different growth rates, risk profiles, and profitability levels. Comparing the P/E ratios of companies from different industries may not provide an accurate picture of their relative valuations. Furthermore, the P/E ratio does not consider other important factors such as the company's competitive position, management quality, and industry dynamics. These factors can significantly impact a company's future earnings potential and, therefore, its valuation. 6.2.2 Diversifying analysis. To overcome the limitations of the P/E ratio, investors should consider using a combination of other valuation metrics and qualitative analysis. Diversifying the analysis allows for a more comprehensive understanding of a company's value and potential risks. One such metric is the price-to-sales (P/S) ratio, which compares a company's market capitalization to its revenue. The P/S ratio can be particularly useful for companies that are in the early stages of growth and may not yet be generating significant earnings. By considering both the P/E ratio and the P/S ratio, investors can gain a more holistic view of a company's valuation. Additionally, investors should conduct qualitative analysis by assessing a company's competitive advantage, market position, and growth prospects. This can be done by analyzing industry trends, conducting competitor analysis, and evaluating the company's management team. By combining quantitative and qualitative analysis, investors can make more informed investment decisions. 6.2.3 Considering earnings quality. Another important consideration when relying on the P/E ratio is the quality of a company's earnings. The P/E ratio is based on reported earnings, which may not always accurately reflect a company's true profitability. Companies can manipulate their earnings through accounting practices, such as aggressive revenue recognition or one-time adjustments. To ensure a more accurate assessment of a company's earnings quality, investors should analyze the company's financial statements, including the income statement, balance sheet, and cash flow statement. By examining the consistency and sustainability of a company's earnings, investors can better evaluate its true value. 6.2.4 Using P/E ratio in context. While the P/E ratio should not be the sole determinant of investment decisions, it can still provide valuable insights when used in the right context. Investors should consider the P/E ratio in conjunction with other financial metrics, industry analysis, and qualitative factors. For example, comparing a company's P/E ratio to its historical average or to the P/E ratios of its industry peers can help identify potential overvaluation or undervaluation. Additionally, analyzing the trend of a company's P/E ratio over time can provide insights into market sentiment and investor expectations. 6.2.5 Seeking professional advice. Investing based solely on the P/E ratio can be risky, especially for individual investors who may not have access to comprehensive financial data or industry expertise. It is advisable to seek professional advice from financial advisors or analysts who can provide a more nuanced analysis of a company's valuation. Professional advisors can help investors navigate the complexities of financial markets and consider a broader range of factors beyond the P/E ratio. They can provide guidance on portfolio diversification, risk management, and investment strategies that align with an investor's financial goals and risk tolerance. Conclusion. While the P/E ratio is a valuable tool for assessing a company's valuation, it is important for investors to avoid over-reliance on this single metric. Understanding the limitations of the P/E ratio and diversifying analysis with other valuation metrics and qualitative factors can lead to more informed investment decisions. By considering the context, earnings quality, and seeking professional advice, investors can mitigate the risks associated with over-reliance on the P/E ratio and make more prudent investment choices. 6.3 Inconsistent earnings quality. One of the common pitfalls in analyzing the P/E ratio is the issue of inconsistent earnings quality. The P/E ratio is calculated by dividing the price of a stock by its earnings per share (EPS). However, the accuracy and reliability of the earnings used in this calculation can vary significantly. 6.3.1 Understanding earnings quality. Earnings quality refers to the reliability and sustainability of a company's reported earnings. High-quality earnings are considered to be accurate, transparent, and reflective of the company's true financial performance. On the other hand, low-quality earnings may be subject to manipulation, misrepresentation, or volatility. There are several factors that can affect earnings quality. These include accounting practices, revenue recognition policies, one-time events, non-recurring items, and management discretion in financial reporting. It is important for investors to understand these factors and assess the consistency and reliability of a company's earnings before relying solely on the P/E ratio for investment decisions. 6.3.2 Impact on P/E ratio analysis. Inconsistent earnings quality can have a significant impact on the interpretation and analysis of the P/E ratio. When earnings quality is low, the P/E ratio may not accurately reflect the true value of a company's stock. This can lead to misleading conclusions and potentially poor investment decisions. For example, if a company reports unusually high earnings due to one-time events or accounting manipulations, the P/E ratio may appear artificially low. This could mistakenly suggest that the stock is undervalued when, in fact, the earnings are not sustainable or representative of the company's long-term performance. Conversely, if a company reports low earnings due to temporary setbacks or non-recurring expenses, the P/E ratio may appear artificially high, potentially leading to an overvaluation of the stock. 6.3.3 Evaluating earnings quality. To mitigate the risks associated with inconsistent earnings quality, investors should conduct a thorough evaluation of a company's financial statements and accounting practices. Here are some key considerations. 6.3.3.1 Financial Statement Analysis. Analyzing a company's financial statements, including the income statement, balance sheet, and cash flow statement, can provide insights into the quality of its earnings. Look for consistency in revenue growth, profit margins, and cash flow generation over time. Assess the company's ability to generate sustainable earnings and cash flows. 6.3.3.2 Accounting Policies and Practices. Understand the company's accounting policies and practices, including revenue recognition, expense capitalization, and inventory valuation methods. Evaluate the conservatism of these policies and assess whether they align with industry norms and regulatory requirements. Be cautious of companies that frequently change accounting methods or have complex and aggressive practices. 6.3.3.3 Non-recurring items and adjustments. Identify and analyze non-recurring items and adjustments in the company's financial statements. These can include one-time gains or losses, restructuring charges, write-offs, or other extraordinary items. Assess the impact of these items on the company's earnings and determine whether they are likely to recur in the future. 6.3.3.4 Management Integrity and Transparency. Evaluate the integrity and transparency of the company's management team. Look for signs of ethical behavior, clear communication, and a commitment to accurate financial reporting. Consider the company's track record in meeting earnings guidance and its responsiveness to investor inquiries. 6.3.4 Alternative valuation metrics. In situations where earnings quality is questionable or inconsistent, it may be prudent to consider alternative valuation metrics in addition to the P/E ratio. Some alternative metrics include 6.3.4.1 Price-to-sales ratio. The price-to-sales (PS) ratio compares a company's market capitalization to its total revenue. This ratio can be useful when earnings are volatile or unreliable. It provides a measure of the company's valuation based on its revenue generation rather than its earnings. 6.3.4.2 Price-to-book ratio. The price-to-book (PB) ratio compares a company's market capitalization to its book value, which is the value of its assets minus its liabilities. This ratio can be helpful when earnings are distorted or manipulated. It provides a measure of the company's valuation based on its underlying assets. 6.3.4.3 Cash flow metrics. Cash flow metrics, such as the price-to-cash flow ratio or the enterprise value-to-EBITDA ratio, focus on a company's cash generation rather than its reported earnings. These metrics can be more reliable indicators of a company's financial health and valuation. 6.3.5 Conclusion. Inconsistent earnings quality is a common pitfall in P/E ratio analysis. It is crucial for investors to carefully evaluate the reliability and sustainability of a company's earnings before making investment decisions solely based on the P/E ratio. By conducting a thorough analysis of a company's financial statements, accounting practices, and management integrity, investors can gain a better understanding of the quality of a company's earnings and make more informed investment choices. Additionally, considering alternative valuation metrics can provide a more comprehensive view of a company's valuation when earnings quality is questionable. 6.4 Misinterpreting P/E ratio changes. The P/E ratio is a widely used financial metric that provides valuable insights into the valuation of a company's stock. However, it is important for investors to understand that changes in the P/E ratio can sometimes be misleading if not properly interpreted. In this section, we will explore some common pitfalls that investors may encounter when analyzing changes in the P/E ratio and provide guidance on how to avoid these misinterpretations. 6.4.1 Overemphasis on short-term P/E ratio changes. One common mistake that investors make is placing too much emphasis on short-term changes in the P/E ratio. The P/E ratio can fluctuate significantly over time due to various factors such as changes in earnings, market sentiment, or economic conditions. It is crucial to remember that the P/E ratio is just one piece of the puzzle and should be considered in conjunction with other fundamental and qualitative factors. For example, a sudden increase in the P/E ratio may be interpreted as a negative signal by some investors, indicating that the stock is overvalued. However, this increase could be justified if the company has experienced a significant improvement in its earnings prospects or if market sentiment has turned positive. Conversely, a decrease in the P/E ratio may be seen as a buying opportunity, but it could also indicate deteriorating fundamentals or negative market sentiment. To avoid misinterpreting short-term changes in the P/E ratio, investors should focus on the underlying factors driving these changes. Conducting thorough fundamental analysis, including evaluating the company's financial health, growth prospects, and competitive position, can provide a more comprehensive understanding of the stock's valuation. 6.4.2 Failure to consider industry norms. Another common mistake is failing to consider industry norms when analyzing changes in the P/E ratio. Different industries have varying growth rates, risk profiles, and profitability levels, which can significantly impact the appropriate P/E ratio for a company within that industry. For instance, technology companies often have higher growth rates and higher P/E ratios compared to more mature industries such as utilities or consumer staples. If an investor compares the P/E ratio of a technology company to that of a utility company without considering the industry norms, they may draw incorrect conclusions about the relative valuation of the stocks. To avoid this misinterpretation, it is essential to compare the P/E ratio of a company to its industry peers. This allows investors to assess whether the company's P/E ratio is in line with industry averages or if it deviates significantly. Understanding the industry dynamics and the factors that drive P/E ratios within that industry can provide valuable context for interpreting changes in the P/E ratio. 6.4.3 Ignoring earnings quality. The quality of earnings is another critical factor that investors should consider when interpreting changes in the P/E ratio. The P/E ratio is calculated based on earnings, and if the earnings are of low quality or subject to manipulation, the P/E ratio may not accurately reflect the true value of the stock. For example, a company may experience a temporary boost in earnings due to one-time events or accounting adjustments. If investors solely focus on the P/E ratio without considering the sustainability and quality of these earnings, they may misinterpret the stock's valuation. To avoid this pitfall, investors should conduct a thorough analysis of the company's financial statements, paying attention to the consistency and reliability of earnings. Factors such as revenue growth, cash flow generation, and the company's accounting policies should be evaluated to ensure the accuracy and sustainability of earnings. By considering the quality of earnings, investors can make more informed decisions when interpreting changes in the P/E ratio. 6.4.4 Failure to consider the context. Lastly, it is crucial to consider the broader market and economic context when analyzing changes in the P/E ratio. Market conditions, such as bull or bear markets, can have a significant impact on the P/E ratio of individual stocks and the overall market. During a bull market, investor optimism and high demand for stocks can drive up P/E ratios, potentially leading to overvaluation. Conversely, during a bear market, pessimism and low investor confidence can result in lower P/E ratios, potentially indicating undervaluation. Failing to consider these market dynamics can lead to misinterpretations of the P/E ratio. Additionally, economic factors such as interest rates, inflation, and GDP growth can influence the P/E ratio. For example, low interest rates and strong economic growth may justify higher P/E ratios, while high interest rates and economic uncertainty may warrant lower P/E ratios. To avoid misinterpreting changes in the P/E ratio, investors should always consider the broader market and economic context. Understanding the prevailing market conditions and economic trends can provide valuable insights into whether changes in the P/E ratio are justified or if they are driven by external factors. In conclusion, while the P/E ratio is a useful tool for evaluating the valuation of a company's stock, it is essential to interpret changes in the P/E ratio with caution. Investors should avoid overemphasizing short-term changes, consider industry norms, evaluate earnings quality, and analyze the broader market and economic context. By avoiding these common pitfalls, investors can make more informed decisions when interpreting changes in the P/E ratio and avoid potential misinterpretations that could lead to suboptimal investment outcomes. 7. Advanced P/E ratio analysis techniques. 7.1 P/E ratio and growth stocks. When it comes to investing in the stock market, one of the key factors that investors consider is the price-to-earnings P/E ratio. The P/E ratio is a valuation metric that compares the price of a stock to its earnings per share (EPS). It is widely used by investors to assess the relative value of a stock and determine whether it is overvalued or undervalued. In this section, we will explore the relationship between the P/E ratio and growth stocks. Growth stocks are companies that are expected to experience above-average growth in earnings and revenue compared to other companies in the market. These companies typically reinvest their earnings back into the business to fuel expansion and innovation. 7.1.1 Understanding growth stocks. Before delving into the relationship between the P/E ratio and growth stocks, it is important to have a clear understanding of what constitutes a growth stock. Growth stocks are typically found in industries that are experiencing rapid technological advancements or have significant market opportunities. These companies often have a competitive advantage, innovative products or services, and a strong track record of revenue and earnings growth. Investing in growth stocks can be rewarding, as they have the potential to generate substantial returns over the long term. However, they also come with a higher level of risk compared to other types of stocks. The success of growth stocks is highly dependent on their ability to sustain and accelerate their growth rates. If a growth stock fails to meet market expectations, it can result in a significant decline in its stock price. 7.1.2 P/E ratio and growth stocks. The P/E ratio is a useful tool for evaluating growth stocks. It provides insights into how the market values a company's earnings growth potential. Generally, growth stocks tend to have higher P/E ratios compared to other types of stocks. This is because investors are willing to pay a premium for companies that are expected to deliver above-average growth. A high P/E ratio indicates that investors have high expectations for future earnings growth. It suggests that the market believes the company has a strong competitive position, innovative products or services, and the ability to generate sustainable growth. However, a high P/E ratio alone does not guarantee future success. It is important to consider other factors such as the company's competitive landscape, industry trends, and management's ability to execute its growth strategy. On the other hand, a low P/E ratio may indicate that the market has lower expectations for future growth. This could be due to concerns about the company's competitive position, industry headwinds, or a lack of confidence in management's ability to deliver on growth targets. However, a low P/E ratio does not necessarily mean that a company is a poor investment. It could present an opportunity to invest in a growth stock at an attractive valuation. 7.1.3 Evaluating growth stocks using the P/E ratio. When evaluating growth stocks using the P/E ratio, it is important to consider the company's growth prospects, industry dynamics, and the overall market environment. Here are a few key points to keep in mind. Comparing P/E ratios. Compare the P/E ratios of different growth stocks within the same industry. This will help you identify companies that are trading at a premium or a discount relative to their peers. However, it is important to consider other factors such as revenue growth, profitability, and competitive advantages. Historical P/E ratios. Analyze the historical P/E ratios of the company to understand how the market has valued its growth in the past. This can provide insights into whether the current P/E ratio is justified or if the stock is overvalued or undervalued. Earnings growth. Evaluate the company's historical and projected earnings growth rates. A high P/E ratio may be justified if the company has a track record of delivering strong earnings growth and is expected to continue doing so in the future. Risk factors. Assess the risks associated with investing in growth stocks. These stocks are often more volatile and sensitive to market conditions. Consider factors such as competition, regulatory risks, and the company's ability to execute its growth strategy. Diversification. Diversify your portfolio by investing in a mix of growth stocks from different industries. This can help mitigate the risks associated with investing in individual companies and industries. Conclusion. The P/E ratio is a valuable tool for evaluating growth stocks. It provides insights into how the market values a company's growth potential and can help investors make informed investment decisions. However, it is important to consider the P/E ratio in conjunction with other factors such as the company's competitive position, industry dynamics, and management's ability to execute its growth strategy. By conducting thorough analysis and due diligence, investors can identify attractive growth stocks that have the potential to deliver long-term value. 7.2 P/E ratio and value stocks. Value investing is a popular investment strategy that focuses on identifying undervalued stocks in the market. One of the key metrics used by value investors is the price-to-earnings P/E ratio. The P/E ratio is a valuation metric that compares a company's stock price to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. In the context of value stocks, the P/E ratio plays a crucial role in determining whether a stock is undervalued or overvalued. Value stocks are typically characterized by having low P/E ratios compared to their peers or the overall market. These stocks are often considered to be trading at a discount, presenting an opportunity for investors to buy them at a lower price relative to their earnings potential. 7.2.1 Understanding value stocks. Value stocks are shares of companies that are believed to be trading below their intrinsic value. These companies are often well established, stable, and have a history of generating consistent earnings. Value investors seek out these stocks because they believe that the market has undervalued them, presenting an opportunity for potential capital appreciation. Value stocks are typically found in industries that are out of favor or facing temporary challenges. These companies may have experienced a decline in their stock price due to factors such as industry downturns, regulatory changes, or temporary setbacks. Value investors believe that these challenges are temporary and that the market will eventually recognize the true value of these companies, leading to a rise in their stock prices. 7.2.2 The role of P/E ratio in value investing. The P/E ratio is a fundamental tool used by value investors to identify potential value stocks. A low P/E ratio suggests that a stock is trading at a lower price relative to its earnings, indicating that it may be undervalued. Value investors often look for stocks with P/E ratios below the average for their industry or the overall market. When analyzing the P/E ratio of value stocks, it is important to consider the context of the company and its industry. A low P/E ratio alone does not guarantee that a stock is undervalued. It is essential to assess the company's financial health, competitive position, and growth prospects to determine if the low P/E ratio is justified. 7.2.3 Benefits of investing in value stocks. Investing in value stocks can offer several benefits to investors. Potential for capital appreciation. Value stocks have the potential to deliver significant capital appreciation if the market recognizes their true value. As the market corrects its undervaluation, the stock price may rise, resulting in capital gains for investors. Dividend income. Many value stocks are mature companies with a history of generating consistent earnings. These companies often distribute a portion of their profits to shareholders in the form of dividends. Investing in value stocks can provide a steady stream of dividend income, which can be particularly attractive for income-focused investors. Lower downside risk. Value stocks are often considered to have lower downside risk compared to growth stocks. Since value stocks are already trading at a discount, there is typically less room for further downside if the market experiences a downturn. This can provide a level of stability and downside protection for investors. Contrarian opportunities. Value investing involves going against the market consensus and investing in stocks that are out of favor. This contrarian approach can present opportunities for investors to buy stocks at a lower price when others are selling, potentially leading to higher returns when the market sentiment changes. 7.2.4 Risks and considerations. While investing in value stocks can be rewarding, it is important to be aware of the risks and considerations associated with this investment strategy. Value traps. Not all stocks with low P/E ratios are undervalued. Some stocks may have low P/E ratios due to fundamental issues or deteriorating financial performance. These stocks are often referred to as value traps and can result in significant losses for investors. Thorough research and analysis are essential to avoid falling into value traps. Market timing. Value investing requires patience and a long-term perspective. It can take time for the market to recognize the value of a stock and for the stock price to appreciate. Investors should be prepared for potential short-term fluctuations and avoid trying to time the market. Industry and company-specific risks. Value stocks are often found in industries facing challenges or undergoing significant changes. Investing in these industries carries inherent risks, such as regulatory changes, technological disruptions, or shifts in consumer preferences. Additionally, individual companies may have their own specific risks, such as management issues or competitive pressures. Limited growth potential. Value stocks are typically mature companies with slower growth rates compared to growth stocks. While they may offer stability and income, they may not provide the same level of capital appreciation as high-growth companies. Investors should consider their investment objectives and risk tolerance when deciding to invest in value stocks. In conclusion, the P/E ratio is a valuable tool for value investors in identifying potential value stocks. By analyzing the P/E ratio in the context of a company's financial health, competitive position, and growth prospects, investors can identify stocks that may be trading at a discount. However, it is important to conduct thorough research and consider the risks associated with value investing before making investment decisions. 7.3 P/E ratio and cyclical stocks. Cyclical stocks are a specific type of investment that tend to follow the economic cycle. These stocks are highly sensitive to changes in the overall economy and typically perform well during periods of economic expansion and growth. As such, analyzing the P/E ratio of cyclical stocks can provide valuable insights into their valuation and potential for future returns. 7.3.1 Understanding cyclical stocks. Before delving into the relationship between the P/E ratio and cyclical stocks, it is important to have a clear understanding of what cyclical stocks are. Cyclical stocks are typically companies that operate in industries that are highly sensitive to changes in the business cycle. These industries include sectors such as manufacturing, construction, automotive, and consumer discretionary. During periods of economic expansion, cyclical stocks tend to perform well as consumer spending increases, businesses invest in new projects, and overall economic activity rises. Conversely, during economic downturns or recessions, cyclical stocks often experience a decline in demand and profitability. 7.3.2 The P/E ratio and cyclical stocks. The P/E ratio is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. The P/E ratio provides investors with an indication of how much they are willing to pay for each dollar of earnings generated by the company. When it comes to cyclical stocks, the P/E ratio can be particularly useful in assessing their valuation. During periods of economic expansion, cyclical stocks tend to experience higher earnings growth, which can lead to an increase in their P/E ratio. This is because investors are willing to pay a premium for stocks that are expected to generate higher earnings in the future. Conversely, during economic downturns, cyclical stocks may experience a decline in earnings, which can result in a decrease in their P/E ratio. This is because investors may become more cautious and less willing to pay a premium for stocks that are expected to generate lower earnings. 7.3.3 Interpreting the P/E ratio for cyclical stocks. Interpreting the P/E ratio for cyclical stocks requires a careful analysis of the underlying economic conditions and the specific industry dynamics. Here are a few key points to consider when interpreting the P/E ratio for cyclical stocks. 7.3.3.1 Comparing the P/E ratio to historical averages. One way to assess the valuation of a cyclical stock is to compare its current P/E ratio to its historical averages. By analyzing the historical P/E ratio, investors can gain insights into whether the stock is currently overvalued or undervalued relative to its own historical performance. During periods of economic expansion, cyclical stocks may trade at higher P/E ratios compared to their historical averages, reflecting the market's optimism about future earnings growth. Conversely, during economic downturns, cyclical stocks may trade at lower P/E ratios as investors become more cautious about the company's future prospects. 7.3.3.2 Understanding earnings volatility. Cyclical stocks are known for their earnings volatility, which can have a significant impact on their P/E ratio. During economic downturns, cyclical stocks may experience a decline in earnings, leading to a higher P/E ratio. Conversely, during economic expansions, cyclical stocks may experience a surge in earnings, resulting in a lower P/E ratio. Investors should be cautious when interpreting the P/E ratio of cyclical stocks during periods of high earnings volatility. It is important to consider the underlying factors driving the earnings volatility and assess whether it is a temporary or long-term trend. 7.3.3.3 Analyzing industry and market conditions. The performance of cyclical stocks is closely tied to industry and market conditions. Analyzing the overall health of the industry and the broader market can provide valuable insights into the future prospects of cyclical stocks. For example, if the industry is experiencing strong demand and positive growth prospects, cyclical stocks within that industry may have higher P/E ratios as investors anticipate future earnings growth. Conversely, if the industry is facing headwinds or a slowdown, cyclical stocks may have lower P/E ratios as investors become more cautious about the company's future earnings potential. 7.3.4 Risks and Considerations. Investing in cyclical stocks can be rewarding but also comes with its own set of risks and considerations. Here are a few key points to keep in mind when analyzing the P/E ratio of cyclical stocks. 7.3.4.1 Economic and market risk. Cyclical stocks are highly sensitive to changes in the overall economy and market conditions. Investing in cyclical stocks during economic downturns or recessions can be risky, as these stocks may experience significant declines in earnings and stock prices. It is important to carefully assess the economic and market conditions before investing in cyclical stocks. 7.3.4.2 Timing the market. Timing the market is notoriously difficult, and this is especially true for cyclical stocks. These stocks can be highly volatile and subject to rapid changes in investor sentiment. Trying to time the market by buying cyclical stocks at the bottom and selling at the top can be challenging and may result in poor investment outcomes. It is important to have a long-term investment strategy and focus on the fundamentals of the company rather than short-term market fluctuations. 7.3.4.3 Diversification. Investing in cyclical stocks carries specific risks due to their sensitivity to economic cycles. To mitigate these risks, it is important to diversify your portfolio across different sectors and asset classes. By diversifying your investments, you can reduce the impact of any single stock or sector on your overall portfolio performance. Conclusion. The P/E ratio is a valuable tool for analyzing cyclical stocks. By understanding the relationship between the P/E ratio and cyclical stocks, investors can gain insights into the valuation and potential future returns of these stocks. However, it is important to consider the specific industry dynamics, economic conditions, and market factors when interpreting the P/E ratio for cyclical stocks. Investing in cyclical stocks requires careful analysis and consideration of the associated risks and considerations. 7.4 P/E ratio and defensive stocks. Defensive stocks are a category of stocks that are known for their stability and resilience during economic downturns or periods of market volatility. These stocks belong to industries that provide essential goods and services, such as utilities, healthcare, consumer staples, and telecommunications. Investors often turn to defensive stocks as a way to protect their portfolios during times of uncertainty. The P/E ratio, or price-to-earnings ratio, is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. The P/E ratio is a useful tool for investors to assess the relative value of a stock and determine if it is overvalued or undervalued. When it comes to defensive stocks, the P/E ratio can provide valuable insights into their investment potential. Here are some key considerations when analyzing the P/E ratio of defensive stocks. 7.4.1 P/E ratio and stability. Defensive stocks are known for their stability and consistent performance, even during challenging market conditions. As a result, these stocks often have higher P/E ratios compared to more volatile stocks. The higher P/E ratio reflects the market's confidence in the company's ability to generate steady earnings and maintain a stable business model. Investors looking for defensive stocks should consider companies with a history of stable earnings growth and a track record of weathering economic downturns. A higher P/E ratio in this context can be justified if the company has a strong competitive position, a solid balance sheet, and a reliable dividend payment history. 7.4.2 P/E ratio and dividend yield. Dividend yield is another important factor to consider when analyzing defensive stocks. These stocks are often favored by income-seeking investors due to their ability to generate consistent dividends. The P/E ratio can help investors assess the sustainability of the dividend payments. A low P/E ratio combined with a high dividend yield may indicate that the stock is undervalued and offers an attractive income opportunity. However, investors should be cautious and investigate further to ensure that the company's financial health supports the dividend payments. 7.4.3 P/E ratio and economic conditions. Defensive stocks tend to perform well during economic downturns or periods of market volatility. When the economy is facing challenges, investors often seek the stability and reliability offered by defensive stocks. As a result, the demand for these stocks increases, leading to higher stock prices and potentially higher P/E ratios. During economic expansions, defensive stocks may experience lower demand, resulting in lower stock prices and lower P/E ratios. Investors should consider the economic conditions and the stage of the business cycle when analyzing the P/E ratio of defensive stocks. A higher P/E ratio during a recession may be justified, while a lower P/E ratio during an economic boom may present a buying opportunity. 7.4.4 P/E ratio and industry comparisons. Comparing the P/E ratio of a defensive stock to its industry peers can provide valuable insights into its relative valuation. Investors should consider the average P/E ratio of the industry and compare it to the P/E ratio of the specific stock they are analyzing. If a defensive stock has a significantly higher P/E ratio compared to its industry average, it may indicate that the stock is overvalued. Conversely, a lower P/E ratio compared to the industry average may suggest that the stock is undervalued. However, investors should also consider other factors such as the company's growth prospects, competitive position, and financial health before making any investment decisions. 7.4.5 P/E ratio and earnings growth. While defensive stocks are known for their stability, it is still important to consider the company's earnings growth potential. A high P/E ratio combined with strong earnings growth may indicate that the market expects the company to continue delivering solid financial performance in the future. Investors should analyze the company's historical earnings growth, as well as its projected earnings growth, to assess the sustainability of the high P/E ratio. It is important to consider both the short-term and long-term earnings growth prospects to make an informed investment decision. In conclusion, the P/E ratio can be a valuable tool for analyzing defensive stocks. Investors should consider the stability of the company, dividend yield, economic conditions, industry comparisons, and earnings growth when interpreting the P/E ratio of defensive stocks. By combining the P/E ratio with other fundamental and qualitative analysis, investors can make more informed investment decisions in the defensive stock sector. 8. Using P/E ratio in different investment strategies. 8.1 P/E ratio in value investing. Value investing is an investment strategy that focuses on identifying undervalued stocks in the market. It involves finding stocks that are trading at a price lower than their intrinsic value, with the expectation that the market will eventually recognize and correct this undervaluation. The price-to-earnings ratio (P/E ratio) is a key metric used in value investing to assess the relative value of a stock. 8.1.1 Understanding value investing. Value investors believe that the market sometimes misprices stocks, creating opportunities for investors to buy them at a discount. They look for stocks that have strong fundamentals but are trading at a lower price compared to their intrinsic value. By identifying these undervalued stocks, value investors aim to generate long-term capital appreciation. 8.1.2 The role of the P/E ratio in value investing. The P/E ratio is a fundamental valuation metric that compares a company's stock price to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. The P/E ratio provides insights into how much investors are willing to pay for each dollar of earnings generated by a company. In value investing, the P/E ratio is used to identify stocks that are trading at a lower multiple compared to their peers or the overall market. A low P/E ratio suggests that a stock may be undervalued, as investors are paying less for each dollar of earnings. Value investors often look for stocks with low P/E ratios as they believe these stocks have the potential for future price appreciation. 8.1.3 Interpreting the P/E ratio in value investing. When using the P/E ratio in value investing, it is important to consider several factors. 8.1.3.1 Historical P/E ratio. Comparing a stock's current P/E ratio to its historical P/E ratio can provide insights into whether the stock is undervalued or overvalued. If the current P/E ratio is significantly lower than the historical average, it may indicate that the stock is undervalued and potentially a good value investment opportunity. 8.1.3.2 Industry comparison. Comparing the P/E ratio of a stock to its industry peers can help determine if the stock is undervalued relative to its sector. If a stock has a lower P/E ratio compared to its industry average, it may suggest that the stock is undervalued and could be a good value investment. 8.1.3.3 Earnings growth. While a low P/E ratio may indicate an undervalued stock, it is important to consider the company's earnings growth potential. A stock with a low P/E ratio but negative or stagnant earnings growth may not be a good value investment. Value investors look for stocks with a combination of low P/E ratios and strong earnings growth prospects. 8.1.3.4 Balance sheet and financial health. In value investing, it is crucial to assess the financial health of a company. A low P/E ratio alone does not guarantee a good value investment. Value investors also consider factors such as the company's debt levels, cash flow, and overall financial stability. 8.1.4 Risks and limitations of using the P/E ratio in value investing. While the P/E ratio is a valuable tool in value investing, it is important to be aware of its limitations and potential risks. 8.1.4.1 Cyclical industries. Certain industries, such as technology or commodities, are more cyclical in nature. These industries may experience significant fluctuations in earnings, which can impact the P/E ratio. Value investors should be cautious when using the P/E ratio in cyclical industries, as it may not accurately reflect the true value of a stock. 8.1.4.2 Earnings manipulation. Companies can manipulate their earnings to artificially inflate or deflate the P/E ratio. Value investors should conduct thorough due diligence to ensure the accuracy and reliability of a company's reported earnings. 8.1.4.3 Market sentiment. The P/E ratio is influenced by market sentiment and investor expectations. During periods of market optimism, stocks may have higher P/E ratios, making it challenging to find undervalued opportunities. Value investors should consider market conditions and investor sentiment when interpreting the P/E ratio. 8.1.5 Strategies for value investing. Using the P/E ratio. Value investors use the P/E ratio in various ways to identify potential value investments. 8.1.5.1 Screening for low P/E stocks. Value investors often screen for stocks with low P/E ratios as a starting point for further analysis. By focusing on stocks with low P/E ratios, investors can identify potential undervalued opportunities. 8.1.5.2 Comparative Analysis. Value investors compare the P/E ratios of different stocks within an industry or sector to identify stocks that are trading at a lower multiple. This comparative analysis helps identify stocks that may be undervalued relative to their peers. 8.1.5.3 Fundamental Analysis. Value investors conduct in-depth fundamental analysis to assess a company's financial health, competitive position, and growth prospects. The P/E ratio is used as one of many metrics in this analysis to determine if a stock is undervalued. 8.1.6 Conclusion. The P/E ratio is a valuable tool in value investing, helping investors identify undervalued stocks. By considering historical trends, industry comparisons, earnings growth, and financial health, value investors can use the P/E ratio to make informed investment decisions. However, it is important to be aware of the limitations and risks associated with using the P/E ratio as the sole basis for investment decisions. Value investing requires a comprehensive analysis of multiple factors to identify truly undervalued opportunities. 8.2 P/E ratio in growth investing. Growth investing is a strategy that focuses on investing in companies that are expected to experience above-average growth in their earnings and revenues. These companies typically operate in industries with high growth potential, such as technology, healthcare, and consumer goods. When it comes to growth investing, the P/E ratio plays a crucial role in evaluating the investment potential of these companies. 8.2.1 Understanding growth investing. Before delving into the role of the P/E ratio in growth investing, it is important to understand the basic principles of this investment strategy. Growth investors seek out companies that have the potential to grow their earnings at a faster rate than the overall market. They are willing to pay a premium for these companies because they believe that the future growth prospects will justify the higher valuation. Growth companies typically reinvest a significant portion of their earnings back into the business to fuel expansion, research and development, and innovation. These companies often prioritize market share and revenue growth over profitability in the early stages of their development. As a result, they may have lower or even negative earnings in the short term, but investors expect that their investments will pay off in the long run. 8.2.2 Evaluating growth stocks using the P/E ratio. The P/E ratio is a valuable tool for growth investors as it helps them assess the relative value of a growth stock compared to its earnings. While traditional value investors may focus on low P/E ratios, growth investors are more interested in the growth potential of a company rather than its current earnings. However, the P/E ratio can still provide valuable insights when evaluating growth stocks. When analyzing growth stocks, it is important to consider both the current P/E ratio and the expected future earnings growth. A high P/E ratio may indicate that the market has high expectations for the company's future growth potential. However, it is essential to assess whether these expectations are realistic and achievable. 8.2.3 Interpreting high P/E ratios in growth investing. In growth investing, it is not uncommon to come across companies with high P/E ratios. This is because investors are willing to pay a premium for the anticipated future growth of these companies. However, it is crucial to differentiate between justified high P/E ratios and those that may be overvalued. A justified high P/E ratio can be supported by strong earnings growth, a competitive advantage, and a clear growth strategy. These companies may be operating in rapidly expanding markets, have innovative products or services, or possess a strong brand presence. Investors believe that the future earnings growth will compensate for the higher valuation. On the other hand, an overvalued high P/E ratio may be a result of market exuberance or unrealistic growth expectations. It is important for growth investors to conduct thorough research and analysis to determine whether the high P/E ratio is justified or if it represents an investment opportunity that should be approached with caution. 8.2.4 Risks and considerations in growth investing. While growth investing can offer significant returns, it is not without risks. Investing in growth stocks requires careful consideration and a long-term perspective. Here are some key factors to consider when using the P/E ratio in growth investing. Volatility. Growth stocks are often more volatile than value stocks due to their higher growth expectations. Investors should be prepared for price fluctuations and be willing to hold their investments for the long term. Earnings growth. The P/E ratio is closely tied to earnings growth. It is important to assess the company's ability to sustain and accelerate its earnings growth over time. Consistency in earnings growth is a key factor to consider. Competitive landscape. Growth companies operate in dynamic industries with fierce competition. It is crucial to evaluate the company's competitive advantage, market position, and ability to adapt to changing market conditions. Management team. The management team plays a critical role in executing the growth strategy of a company. Assessing the track record and capabilities of the management team is essential in evaluating the long-term growth potential. Valuation. While the P/E ratio is an important metric, it should not be the sole factor in investment decision-making. Investors should consider other valuation metrics, such as price-to-sales ratio, price-to-book ratio, and discounted cash flow analysis, to gain a comprehensive understanding of the company's valuation. 8.2.5 Case Study. Growth investing and the P/E ratio. To illustrate the role of the P/E ratio in growth investing, let's consider a hypothetical case study of a technology company, XYZ Inc. XYZ Inc. operates in a rapidly growing industry and has consistently delivered strong earnings growth over the past few years. As a result, the company has a high P/E ratio compared to its peers. Growth investors analyzing XYZ Inc. would consider the high P/E ratio as an indication of the market's confidence in the company's future growth prospects. They would assess the company's competitive position, market share, and product pipeline to determine if the high valuation is justified. Additionally, growth investors would closely monitor the company's earnings growth trajectory and evaluate whether it aligns with the market's expectations. If the company fails to meet or exceed the anticipated growth, the high P/E ratio may be considered overvalued, and investors may need to reevaluate their investment thesis. Conclusion. In growth investing, the P/E ratio serves as a valuable tool for evaluating the relative value of growth stocks. While growth investors focus on the future growth potential of a company, the P/E ratio provides insights into the market's expectations and the company's earnings performance. By considering the P/E ratio alongside other factors, growth investors can make informed investment decisions and navigate the dynamic landscape of growth investing. 8.3 P/E ratio in dividend investing. Dividend investing is a popular investment strategy that focuses on investing in companies that pay regular dividends to their shareholders. Dividends are a portion of a company's profits that are distributed to shareholders as a return on their investment. When it comes to dividend investing, the P/E ratio plays a crucial role in evaluating the attractiveness of dividend-paying stocks. 8.3.1 Understanding dividend investing. Dividend investing is based on the principle of generating a steady income stream from investments. Investors who follow this strategy seek out companies that have a history of paying consistent and increasing dividends over time. Dividend-paying stocks are often considered more stable and less volatile compared to growth stocks, making them attractive to income-focused investors. 8.3.2 The role of the P/E ratio in dividend investing. The P/E ratio is a valuable tool for dividend investors as it helps assess the relative value of dividend-paying stocks. It provides insights into how much investors are willing to pay for each dollar of earnings generated by a company. In dividend investing, the P/E ratio is used to evaluate the sustainability and attractiveness of a company's dividend payments. 8.3.3 Evaluating dividend sustainability. One of the key considerations for dividend investors is the sustainability of a company's dividend payments. The P/E ratio can help determine if a company's earnings are sufficient to support its dividend payouts. A low P/E ratio may indicate that a company's stock is undervalued, potentially offering an attractive entry point for dividend investors. However, it is essential to consider other factors such as the company's financial health, cash flow, and dividend history before making investment decisions solely based on the P/E ratio. 8.3.4 Dividend yield and the P/E ratio. Dividend yield is another important metric for dividend investors, and it can be closely related to the P/E ratio. Dividend yield is calculated by dividing the annual dividend per share by the stock price. The P/E ratio can help determine if a company's dividend yield is sustainable or if it is artificially inflated due to a low stock price. A high P/E ratio combined with a high dividend yield may indicate that the market has doubts about the sustainability of the company's dividend payments. 8.3.5 Dividend growth and the P/E ratio. Dividend growth is a key factor for long-term dividend investors. Companies that consistently increase their dividends over time are often seen as attractive investments. The P/E ratio can provide insights into a company's potential for future dividend growth. A low P/E ratio combined with a history of increasing dividends may indicate that the company has the potential to continue increasing its dividend payments in the future. 8.3.6 Risks and considerations. While the P/E ratio is a useful tool for dividend investors, it is important to consider its limitations and other factors when making investment decisions. Dividend investing should not solely rely on the P/E ratio but should also consider the company's financial health, industry trends, and overall market conditions. Additionally, dividend investors should be aware that high dividend yields may sometimes be a result of a declining stock price, indicating potential risks. 8.3.7 Case Study, Company D. To illustrate the application of the P/E ratio in dividend investing, let's consider a case study of Company D. Company D is a well-established company in the consumer goods industry that has a history of paying consistent dividends. The company has a P/E ratio of 15, indicating that investors are willing to pay 15 times the company's earnings for each share. The dividend yield of Company D is 4%, which is considered relatively high compared to industry peers. Based on the P/E ratio and dividend yield, dividend investors may find Company D attractive. The relatively low P/E ratio suggests that the stock may be undervalued, and the high dividend yield indicates a potentially attractive income stream. However, before making any investment decisions, dividend investors should conduct further analysis, including evaluating the company's financials, dividend growth prospects, and overall market conditions. 8.3.8 Conclusion. The P/E ratio is a valuable tool for dividend investors as it helps assess the attractiveness and sustainability of dividend-paying stocks. By considering the P/E ratio, dividend yield, and dividend growth, investors can make more informed decisions when selecting stocks for their dividend portfolios. However, it is important to remember that the P/E ratio should not be the sole determinant of investment decisions and should be used in conjunction with other fundamental and qualitative analysis. 8.4 P/E ratio in momentum investing. Momentum investing is a strategy that focuses on buying stocks that have shown strong price performance in the recent past and selling stocks that have shown weak price performance. It is based on the belief that stocks that have been performing well will continue to do so in the near future, while stocks that have been performing poorly will continue to underperform. The P/E ratio can be a useful tool in momentum investing as it provides insights into the market's perception of a company's earnings potential. 8.4.1 Understanding momentum investing. Momentum investing is based on the idea that stock prices tend to move in trends. Stocks that have been performing well in terms of price appreciation are expected to continue their upward trajectory, while stocks that have been declining in price are expected to continue their downward trend. This strategy relies on the assumption that market participants tend to underreact to new information, causing stock prices to adjust slowly to new developments. Momentum investors typically look for stocks with strong positive price momentum over a specific time period, such as the past 6 to 12 months. They aim to capture the upward momentum and ride the wave of positive price performance. The goal is to buy stocks that are already in an uptrend and sell them before the trend reverses. 8.4.2 Role of P/E ratio in momentum investing. The P/E ratio can play a significant role in momentum investing by providing insights into the market's perception of a company's earnings potential. Momentum investors often look for stocks with high P/E ratios, as this indicates that the market has high expectations for future earnings growth. A high P/E ratio suggests that investors are willing to pay a premium for the stock based on the expectation of strong future performance. When evaluating stocks for momentum investing, investors may compare the P/E ratios of different companies within the same industry or sector. A stock with a higher P/E ratio compared to its peers may indicate that it has stronger growth prospects and is attracting more investor interest. This can be a positive signal for momentum investors looking for stocks with upward price momentum. However, it is important to note that momentum investing based solely on high P/E ratios can be risky. Stocks with high P/E ratios may already be overvalued, and there is a risk of a price correction if the market's expectations are not met. Therefore, momentum investors need to consider other factors such as earnings growth, market sentiment, and overall market conditions in conjunction with the P/E ratio. 8.4.3 Momentum investing strategies using the P/E ratio. Momentum investors can use the P/E ratio in various ways to identify potential investment opportunities. Here are a few strategies that incorporate the P/E ratio in momentum investing. 8.4.3.1 Relative P/E ratio analysis. One approach is to compare the P/E ratios of different stocks within the same industry or sector. Momentum investors may look for stocks with higher P/E ratios compared to their peers, indicating that they are outperforming the market and attracting more investor interest. This relative P/E ratio analysis can help identify stocks with strong price momentum. 8.4.3.2 P/E ratio breakouts. Another strategy is to identify stocks that have experienced a significant increase in their P/E ratios. Momentum investors may look for stocks that have recently broken out to new P/E ratio highs, indicating a shift in market sentiment and increased investor optimism. This breakout in the P/E ratio can be a signal of potential upward price momentum. 8.4.3.3 P/E ratio divergence. Momentum investors can also look for divergences between a stock's price performance and its P/E ratio. If a stock's price has been steadily increasing, but its P/E ratio has been declining or remaining relatively low, it may indicate that the stock is undervalued and has the potential for a price correction. This divergence can be a signal for momentum investors to consider buying the stock. 8.4.4 Risks and considerations. While momentum investing can be profitable, it is not without risks. Momentum stocks can be volatile and subject to sudden reversals, especially if market conditions change or new information emerges. Therefore, it is important for momentum investors to have a disciplined approach and to closely monitor their investments. When using the P/E ratio in momentum investing, it is crucial to consider other factors such as earnings growth, market sentiment, and overall market conditions. The P/E ratio alone may not provide a complete picture of a stock's potential for price momentum. It is also important to be aware of the limitations of the P/E ratio, such as its inability to capture future earnings growth accurately. Furthermore, momentum investing requires active monitoring and regular portfolio rebalancing. Stocks that have shown strong price momentum may eventually lose their momentum, and it is essential to sell them before the trend reverses. Similarly, stocks that have been underperforming may eventually rebound, and it is crucial to identify and capture such opportunities. In conclusion, the P/E ratio can be a valuable tool in momentum investing as it provides insights into the market's perception of a company's earnings potential. By incorporating the P/E ratio into their analysis, momentum investors can identify stocks with strong price momentum and potentially profit from their upward trajectory. However, it is important to consider other factors and to actively manage investments to mitigate risks associated with momentum investing. 9. P/E ratio and market efficiency. 9.1 Efficient Market Hypothesis and the P/E Ratio. Efficient Market Hypothesis (EMH) is a theory that suggests that financial markets are efficient and that all available information is already reflected in the prices of securities. According to EMH, it is impossible to consistently achieve above-average returns by using any publicly available information, such as the P/E ratio. This theory has important implications for the use of the P/E ratio in investment decision-making. 9.1.1 The three forms of efficient market hypothesis EMH is typically divided into three forms: weak form, semi-strong form, and strong form. Weak form efficiency. In weak form efficiency, the current prices of securities already reflect all past market data, including historical prices and trading volumes. This means that technical analysis, which relies on historical price patterns, would not be able to consistently generate excess returns. Therefore, the P/E ratio, as a fundamental analysis tool, would also be unable to provide any advantage in predicting future stock prices. Semi-strong form efficiency. Semi-strong form efficiency goes beyond weak form efficiency by suggesting that all publicly available information, including financial statements, news, and other market data, is already incorporated into stock prices. This implies that even if an investor analyzes the P/E ratio and other fundamental indicators, they would not be able to consistently outperform the market because the information is already reflected in the stock prices. Strong form efficiency. Strong form efficiency is the most extreme form of EMH, suggesting that all information, both public and private, is already reflected in stock prices. This means that even insider information would not provide an advantage to investors. If strong form efficiency holds, then the P/E ratio would have no predictive power, as all relevant information is already incorporated into stock prices. 9.1.2 Implications for the P/E ratio. The efficient market hypothesis has significant implications for the use of the P/E ratio in investment decision-making. If markets are truly efficient, then the P/E ratio would not be a reliable indicator for identifying undervalued or overvalued stocks. Investors would not be able to consistently generate excess returns by buying stocks with low P/E ratios and selling stocks with high P/E ratios. However, it is important to note that the efficient market hypothesis is a theoretical concept and does not necessarily reflect the reality of financial markets. While there is evidence to support the idea of market efficiency, there are also numerous studies that suggest the presence of market anomalies and inefficiencies. 9.1.3 Market anomalies and the P/E ratio. Market anomalies refer to patterns or behaviors in financial markets that contradict the efficient market hypothesis. These anomalies suggest that certain investment strategies, including those based on the P/E ratio, can generate excess returns over the long term. One such anomaly is the value effect, which suggests that stocks with low P/E ratios tend to outperform stocks with high P/E ratios. This contradicts the efficient market hypothesis, as it implies that the P/E ratio can provide valuable information for identifying undervalued stocks. Another anomaly is the small cap effect, which suggests that small cap stocks tend to outperform large cap stocks over the long term. This effect is often attributed to the fact that small cap stocks are less followed by analysts and therefore may be more likely to be mispriced, providing opportunities for investors to identify undervalued stocks using indicators such as the P/E ratio. 9.1.4 Behavioral biases in P/E ratio analysis. Even if markets are not perfectly efficient, behavioral biases can still affect the interpretation and use of the P/E ratio. Behavioral biases refer to the systematic errors in judgment and decision-making that individuals often exhibit. One common bias is the anchoring bias, where investors rely too heavily on a specific piece of information, such as the P/E ratio, and anchor their investment decisions around it. This can lead to overvaluation or undervaluation of stocks based solely on the P/E ratio, without considering other relevant factors. Another bias is the confirmation bias, where investors seek out information that confirms their pre-existing beliefs or opinions. If an investor believes that a stock is undervalued based on its low P/E ratio, they may selectively focus on information that supports this belief while ignoring contradictory evidence. 9.1.5 Market efficiency strategies. Despite the presence of market anomalies and behavioral biases, many investors still believe in the concept of market efficiency and use strategies that align with this belief. These strategies often involve passive investing, such as investing in index funds or exchange-traded funds (ETFs) that aim to replicate the performance of a specific market index. Passive investing is based on the idea that it is difficult to consistently outperform the market, and therefore, investors should aim to match the market returns rather than trying to beat them. In this context, the P/E ratio can still be a useful tool for comparing the valuation of different stocks within an index or sector. Additionally, some investors may use the P/E ratio as a screening tool to identify stocks that may be worth further analysis. While the P/E ratio alone may not provide a complete picture of a company's value, it can serve as a starting point for further investigation into a company's financial health and prospects. In conclusion, the efficient market hypothesis suggests that financial markets are efficient and that all available information is already reflected in stock prices. This has implications for the use of the P/E ratio as a tool for investment decision-making. While the efficient market hypothesis implies that the P/E ratio may not provide an advantage in predicting future stock prices, the presence of market anomalies and behavioral biases suggests that the P/E ratio can still be a valuable tool for identifying undervalued stocks. Investors should consider both the efficient market hypothesis and the potential limitations and biases in P/E ratio analysis when making investment decisions. 9.2 P/E ratio and market anomalies. The price-to-earnings P/E ratio is a widely used financial metric that helps investors assess the relative value of a company's stock. It is calculated by dividing the market price per share by the earnings per share. The P/E ratio provides insights into how much investors are willing to pay for each dollar of earnings generated by a company. While the P/E ratio is a valuable tool for investors, it is important to recognize that it is not without its limitations. One such limitation is the presence of market anomalies, which are deviations from the expected behavior of the P/E ratio. These anomalies can create opportunities for investors to exploit mispriced stocks or to identify market inefficiencies. 9.2.1 Value Growth Anomaly. One of the most well-known market anomalies related to the P/E ratio is the value growth anomaly. This anomaly suggests that stocks with low P/E ratios, value stocks, tend to outperform stocks with high P/E ratios, growth stocks, over the long term. This finding contradicts the efficient market hypothesis, which assumes that stock prices fully reflect all available information. The value growth anomaly has been extensively studied by researchers and has been observed in various markets around the world. Several explanations have been proposed to explain this anomaly. One possible explanation is that investors tend to overvalue growth stocks, leading to inflated P/E ratios. As a result, value stocks with lower P/E ratios may be undervalued and present attractive investment opportunities. Investors can take advantage of the value growth anomaly by incorporating a value investing strategy into their portfolio. This strategy involves identifying undervalued stocks with low P/E ratios and holding them for the long term. By focusing on companies with solid fundamentals and reasonable valuations, investors can potentially achieve superior returns compared to the overall market. 9.2.2 Size Anomaly. Another market anomaly related to the P/E ratio is the size anomaly. This anomaly suggests that smaller companies with lower market capitalizations tend to have higher P/E ratios and outperform larger companies with higher market capitalizations. This finding challenges the notion that larger companies are inherently safer or more profitable investments. The size anomaly has been observed in various studies and is often attributed to the higher growth potential of smaller companies. Smaller companies may have more room for expansion and may be able to generate higher earnings growth rates, leading to higher P/E ratios. Additionally, smaller companies may be less followed by analysts and institutional investors, which can create opportunities for mispricing. Investors can exploit the size anomaly by considering smaller companies with attractive P/E ratios in their investment strategy. By diversifying their portfolio across companies of different sizes, investors can potentially benefit from the higher growth potential and undervaluation of smaller companies. 9.2.3 Momentum Anomaly. The momentum anomaly is another market anomaly that can impact the P/E ratio. This anomaly suggests that stocks that have performed well in the past tend to continue to perform well in the future, while stocks that have performed poorly tend to continue to underperform. This finding contradicts the efficient market hypothesis, which assumes that stock prices follow a random walk and do not exhibit predictable patterns. The momentum anomaly can influence the P/E ratio by causing stocks with strong recent performance to have higher P/E ratios. Investors may be willing to pay a premium for stocks that have shown positive momentum, leading to inflated P/E ratios. Conversely, stocks with poor recent performance may have lower P/E ratios as investors become more skeptical about their future prospects. Investors can take advantage of the momentum anomaly by incorporating a momentum investing strategy into their portfolio. This strategy involves buying stocks that have shown positive momentum and selling stocks that have shown negative momentum. By following the trend and riding the wave of positive performance, investors can potentially achieve above-average returns. 9.2.4 Other market anomalies. In addition to the value growth, size, and momentum anomalies, there are several other market anomalies that can impact the P/E ratio. These include the earnings announcement anomaly, the post-earnings announcement drift anomaly, and the accrual anomaly, among others. Each of these anomalies suggests that the P/E ratio may not fully capture the underlying value or future prospects of a company. These market anomalies highlight the importance of conducting thorough analysis and considering multiple factors when using the P/E ratio for investment decisions. While the P/E ratio is a useful tool, it should not be the sole determinant of investment choices. Investors should consider other financial metrics, qualitative factors, and market conditions to make well-informed investment decisions. By understanding and recognizing market anomalies, investors can potentially identify mispriced stocks and take advantage of market inefficiencies. However, it is important to note that market anomalies may not persist indefinitely, and their effectiveness may vary over time and across different market conditions. Therefore, investors should continuously monitor and adapt their investment strategies to stay ahead in an ever-changing market environment. 9.3 Behavioral biases in P/E ratio analysis. When it comes to analyzing the P/E ratio, it is important to be aware of the various behavioral biases that can influence our decision-making process. Behavioral biases are cognitive and emotional tendencies that can lead to irrational judgments and decisions. These biases can significantly impact our interpretation of the P/E ratio and may lead to suboptimal investment decisions. In this section, we will explore some common behavioral biases that investors should be mindful of when analyzing the P/E ratio. 9.3.1 Anchoring bias. Anchoring bias refers to the tendency to rely too heavily on the first piece of information encountered when making decisions. In the context of P/E ratio analysis, this bias can manifest when investors anchor their valuation judgments to a specific P/E ratio without considering other relevant factors. For example, if an investor sees that a stock has a low P/E ratio compared to its historical average, they may assume it is undervalued without considering other fundamental factors such as earnings growth prospects or industry trends. It is important to avoid anchoring bias by considering a range of valuation metrics and not solely relying on the P/E ratio. 9.3.2 Confirmation bias. Confirmation bias is the tendency to seek out information that confirms our pre-existing beliefs or hypotheses while ignoring or downplaying contradictory evidence. In the context of P/E ratio analysis, confirmation bias can lead investors to selectively focus on information that supports their initial assessment of a stock's value based on its P/E ratio. This bias can prevent investors from critically evaluating other relevant factors that may impact the stock's valuation. To overcome confirmation bias, it is crucial to actively seek out and consider alternative viewpoints and information that may challenge our initial assumptions. 9.3.3 Herding behavior. Herding behavior refers to the tendency of individuals to follow the actions and decisions of a larger group, often without questioning or independently evaluating the information. In the context of P/E ratio analysis, herding behavior can lead investors to make investment decisions solely based on the consensus opinion or market sentiment regarding a stock's P/E ratio. This can result in a lack of independent analysis and potentially lead to investment decisions that are not based on sound fundamentals. To avoid herding behavior, investors should conduct their own thorough analysis and consider a range of factors beyond just the P/E ratio. 9.3.4 Overconfidence bias. Overconfidence bias is the tendency to overestimate one's own abilities and the accuracy of one's judgments and predictions. In the context of P/E ratio analysis, overconfidence bias can lead investors to place too much confidence in their ability to accurately predict future earnings and make investment decisions solely based on the P/E ratio. This bias can result in excessive risk-taking or overlooking other important factors that may impact a stock's valuation. To mitigate overconfidence bias, it is important to maintain a healthy level of skepticism and regularly reassess and update our analysis based on new information. 9.3.5 Availability bias. Availability bias refers to the tendency to rely on readily available information or examples that come to mind easily when making judgments or decisions. In the context of P/E ratio analysis, availability bias can lead investors to overweight recent or highly publicized examples of stocks with extreme P/E ratios, without considering the broader distribution of P/E ratios across the market. This bias can result in an inaccurate assessment of a stock's value and potentially lead to suboptimal investment decisions. To overcome availability bias, investors should actively seek out a diverse range of information and consider the full spectrum of P/E ratios in their analysis. 9.3.6 Loss aversion bias. Loss aversion bias refers to the tendency to strongly prefer avoiding losses over acquiring gains. In the context of P/E ratio analysis, loss aversion bias can lead investors to be overly cautious and avoid stocks with high P/E ratios, even if they have strong growth prospects. This bias can result in missed investment opportunities and a failure to capture potential gains. To overcome loss aversion bias, investors should focus on the overall risk-reward profile of a stock and consider the potential for future earnings growth, rather than solely relying on the P/E ratio as an indicator of risk. 9.3.7 Recency bias. Recency bias is the tendency to overweight recent events or information when making judgments or decisions. In the context of P/E ratio analysis, recency bias can lead investors to place excessive importance on the most recent earnings data or market trends, without considering the longer-term performance or fundamental factors that may impact a stock's valuation. This bias can result in a narrow focus and potentially lead to suboptimal investment decisions. To mitigate recency bias, investors should take a longer-term perspective and consider a range of historical data and trends when analyzing the P/E ratio. In conclusion, behavioral biases can significantly impact our interpretation of the P/E ratio and may lead to suboptimal investment decisions. By being aware of these biases and actively working to mitigate their influence, investors can improve their analysis and decision-making process. It is important to approach P/E ratio analysis with a critical mindset, considering a range of factors beyond just the P/E ratio and actively seeking out alternative viewpoints and information. By doing so, investors can make more informed and rational investment decisions. 9.4 P/E ratio and market efficiency strategies. The P/E ratio, also known as the price-to-earnings ratio, is a widely used financial metric that helps investors assess the valuation of a company's stock. It is calculated by dividing the market price per share by the earnings per share. The P/E ratio provides valuable insights into the market's perception of a company's future earnings potential and its relative value compared to other companies in the same industry. In this section, we will explore how the P/E ratio can be used in market efficiency strategies. Market efficiency refers to the degree to which stock prices reflect all available information. Efficient markets are characterized by prices that accurately reflect the intrinsic value of a stock, leaving little room for investors to consistently outperform the market. However, some strategies can still be employed to potentially exploit market inefficiencies, and the P/E ratio can play a role in these strategies. 9.4.1 P/E ratio and value investing. Value investing is an investment strategy that involves identifying undervalued stocks and investing in them with the expectation that their prices will eventually rise to reflect their true value. The P/E ratio is a key tool used by value investors to identify such opportunities. A low P/E ratio relative to the industry or historical average may indicate that a stock is undervalued. Value investors believe that the market sometimes misprices stocks due to short-term market fluctuations or investor sentiment. By focusing on the P/E ratio, value investors can identify stocks that are trading at a discount to their intrinsic value. They believe that over time, the market will recognize the true value of these stocks, leading to price appreciation. However, it is important to note that a low P/E ratio alone does not guarantee that a stock is undervalued. Other factors, such as the company's financial health, growth prospects, and competitive position, should also be considered. Value investors conduct thorough fundamental analysis to assess the overall attractiveness of a stock before making investment decisions. 9.4.2 P/E ratio and growth investing. Growth investing is an investment strategy that focuses on identifying companies with strong growth potential. These companies typically have high P/E ratios as investors are willing to pay a premium for their expected future earnings growth. Growth investors believe that these companies will continue to deliver above-average earnings growth, leading to higher stock prices. The P/E ratio can be used by growth investors to assess the market's expectations for future earnings growth. A high P/E ratio may indicate that the market has high expectations for the company's future performance. However, it is important to consider other factors such as the company's competitive position, industry trends, and management's ability to execute its growth strategy. Growth investors are willing to pay a higher price for stocks with high growth potential, even if their P/E ratios are above the industry average. They believe that the market may not fully appreciate the company's growth prospects, providing an opportunity for capital appreciation. 9.4.3 P/E ratio and momentum investing. Momentum investing is a strategy that involves buying stocks that have shown strong price performance in the recent past, with the expectation that the upward trend will continue. The P/E ratio can be used by momentum investors to identify stocks that are attracting positive market attention. Momentum investors look for stocks with high P/E ratios, indicating that the market has high expectations for future earnings growth. They believe that positive price momentum will continue as more investors are attracted to these stocks. However, it is important to note that momentum investing carries higher risk as it relies on the continuation of market trends. Momentum investors typically have shorter investment horizons and may exit positions when the stock's price momentum starts to weaken. They rely on technical analysis and market indicators to identify entry and exit points, rather than conducting in-depth fundamental analysis. 9.4.4 P/E ratio and contrarian investing. Contrarian investing is a strategy that involves taking positions opposite to the prevailing market sentiment. Contrarian investors believe that the market sometimes overreacts to news or events, leading to mispriced stocks. The P/E ratio can be used by contrarian investors to identify stocks that are out of favor with the market. Contrarian investors look for stocks with low P/E ratios, indicating that the market has low expectations for future earnings growth. They believe that the market may have overreacted to negative news or events, creating an opportunity to buy undervalued stocks. Contrarian investing requires patience and a contrarian mindset, as it may take time for the market sentiment to change. Contrarian investors conduct thorough fundamental analysis to assess the reasons behind the market's negative sentiment and the potential for a turnaround. They look for catalysts that could change the market's perception of the stock, such as new product launches, management changes, or industry trends. 9.4.5 P/E ratio and market efficiency. While the P/E ratio can be a useful tool in various investment strategies, it is important to recognize that markets are generally efficient and reflect all available information. The P/E ratio alone may not be sufficient to consistently outperform the market. Other factors, such as company-specific risks, macroeconomic conditions, and investor sentiment, can also influence stock prices. Investors should consider a holistic approach to investment decision-making, incorporating multiple financial metrics, qualitative analysis, and a thorough understanding of the company and its industry. It is also important to diversify investments across different asset classes and sectors to manage risk effectively. In conclusion, the P/E ratio can be a valuable tool in market efficiency strategies such as value investing, growth investing, momentum investing, and contrarian investing. However, investors should exercise caution and conduct thorough analysis before making investment decisions solely based on the P/E ratio. By combining the P/E ratio with other financial metrics and market indicators, investors can enhance their understanding of a company's valuation and make more informed investment choices. 10. Future trends in P/E ratio analysis. 10.1 Technological advancements in the P/E ratio. Technological advancements have had a significant impact on various aspects of the financial world, including the analysis and interpretation of the price-to-earnings P/E ratio. The P/E ratio is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It provides investors with insights into the market's perception of a company's future earnings potential and its relative value compared to its peers. As technology continues to evolve, it is crucial for investors to understand how these advancements can influence the interpretation and application of the P/E ratio. 10.1.1 Big Data and the P/E ratio. One of the most significant technological advancements in recent years is the proliferation of big data. Big data refers to the vast amount of structured and unstructured data that is generated every day. This data can be collected from various sources, such as social media, online platforms, and financial statements. The availability of big data has revolutionized the way investors analyze and interpret the P/E ratio. With the help of advanced data analytics tools and algorithms, investors can now access and process large volumes of data to gain insights into a company's financial performance and market sentiment. By incorporating big data into P/E ratio analysis, investors can identify trends, patterns, and correlations that were previously difficult to detect. This enhanced understanding can lead to more accurate valuations and investment decisions. 10.1.2 Artificial Intelligence and Machine Learning. Artificial intelligence (AI) and machine learning (ML) technologies have also played a crucial role in transforming the analysis of the P/E ratio. AI and ML algorithms can process vast amounts of data and identify complex patterns and relationships that may not be apparent to human analysts. These technologies can analyze historical P/E ratios, earnings growth rates, industry trends, and other relevant factors to generate predictive models and forecasts. By leveraging AI and ML, investors can gain valuable insights into the future performance of a company and its potential impact on the P/E ratio. These technologies can help identify undervalued or overvalued stocks by analyzing a wide range of factors that influence the P/E ratio. Additionally, AI and ML can automate the analysis process, saving time and resources for investors. 10.1.3 High-frequency trading and P/E ratio volatility. High-frequency trading (HFT) is another technological advancement that has had a profound impact on financial markets. HFT refers to the use of powerful computers and algorithms to execute trades at extremely high speeds. This technology has significantly increased market liquidity and trading volumes but has also introduced new challenges for investors analyzing the P/E ratio. HFT can lead to increased volatility in stock prices, which can, in turn, affect the P/E ratio. Rapid price fluctuations can distort the P/E ratio, making it difficult for investors to make accurate valuations. Additionally, HFT can amplify market sentiment and herd behavior, leading to exaggerated P/E ratios during periods of market exuberance or panic. Investors need to be aware of these potential distortions and consider them when interpreting the P/E ratio in highly volatile market conditions. 10.1.4 Fintech and P/E ratio accessibility. Financial technology, or fintech, has made significant strides in improving the accessibility and availability of financial information, including the P/E ratio. Fintech companies have developed user-friendly platforms and applications that provide investors with real-time access to financial data, news, and analysis. These platforms often include P/E ratio calculators and comparison tools, allowing investors to quickly assess the relative value of different stocks. The increased accessibility of the P/E ratio through fintech has democratized investment analysis, enabling individual investors to make more informed decisions. Investors can now access historical P/E ratios, industry benchmarks, and other relevant data with just a few clicks. This accessibility has empowered investors to conduct their own P/E ratio analysis and make investment decisions based on their unique investment goals and risk tolerance. 10.1.5 Cybersecurity and data integrity. As technology advances, so does the importance of cybersecurity and data integrity in the analysis of the P/E ratio. With the increasing reliance on digital platforms and data-driven analysis, the protection of sensitive financial information has become paramount. Investors need to ensure that the data they use to calculate and interpret the P/E ratio is accurate, reliable, and secure. Cybersecurity measures, such as encryption, firewalls, and secure data storage, are essential to safeguarding financial data from unauthorized access or manipulation. Investors should also be aware of potential data breaches or cyber attacks that could compromise the integrity of the P/E ratio and other financial metrics. By prioritizing cybersecurity and data integrity, investors can have confidence in the accuracy and reliability of their P/E ratio analysis. In conclusion, technological advancements have significantly influenced the analysis and interpretation of the P/E ratio. Big data, AI, ML, HFT, fintech, and cybersecurity have all played crucial roles in shaping the way investors analyze and apply the P/E ratio. As technology continues to evolve, it is essential for investors to stay informed and adapt their analysis techniques to leverage these advancements effectively. By embracing technological innovations, investors can enhance their understanding of the P/E ratio and make more informed investment decisions. 10.2 Globalization and the P/E ratio. Globalization has had a significant impact on various aspects of the financial world, including the way we analyze and interpret financial ratios such as the price-to-earnings P/E ratio. As economies become increasingly interconnected and companies expand their operations across borders, it is essential to understand how globalization influences the P/E ratio and its implications for investors. 10.2.1 The globalization effect on P/E ratios. Globalization has led to the integration of financial markets worldwide, allowing investors to access a broader range of investment opportunities. As a result, the P/E ratio has become a more relevant and widely used metric for comparing the valuation of companies across different countries and regions. One of the key effects of globalization on the P/E ratio is the increased competition among companies. As businesses expand their operations globally, they face competition from both domestic and international players. This competition can impact a company's profitability and growth prospects, which in turn affects its P/E ratio. Companies operating in highly competitive industries may experience lower P/E ratios due to the pressure on their earnings. Furthermore, globalization has also led to the integration of supply chains and the movement of production facilities to countries with lower labor costs. This shift in production can impact a company's profitability and, consequently, its P/E ratio. Companies that successfully leverage globalization to reduce costs and increase efficiency may experience higher P/E ratios as investors perceive them as more profitable and valuable. 10.2.2 Cross-border investments and P/E ratios. Globalization has facilitated cross-border investments, allowing investors to diversify their portfolios by investing in companies from different countries. When analyzing the P/E ratio of foreign companies, investors need to consider several factors that may differ from domestic companies. Firstly, investors should be aware of the differences in accounting standards and practices across countries. Different accounting standards can impact the calculation of earnings, which directly affects the P/E ratio. It is crucial to understand the accounting principles used by the company and make appropriate adjustments when comparing P/E ratios across borders. Secondly, investors should consider the economic and political risks associated with investing in foreign markets. Factors such as currency fluctuations, regulatory changes, and geopolitical events can significantly impact a company's earnings and, consequently, its P/E ratio. It is essential to assess the stability and growth prospects of the foreign market before making investment decisions based on P/E ratios. 10.2.3 Global economic factors and P/E ratios. Globalization has interconnected economies, making them more susceptible to global economic factors. These factors can influence a company's earnings and, consequently, its P/E ratio. Investors need to consider the following global economic factors when analyzing P/E ratios. 10.2.3.1 Exchange rates. Exchange rates play a crucial role in determining the profitability of companies operating in international markets. Fluctuations in exchange rates can impact a company's earnings when translating foreign currency revenues and expenses into the domestic currency. These currency effects can distort the P/E ratio and should be carefully considered when comparing companies operating in different countries. 10.2.3.2 Interest rates. Global interest rates can affect a company's cost of capital and borrowing costs, which, in turn, impact its earnings and valuation. Changes in interest rates can influence the P/E ratio by altering the discount rate used to value future earnings. Higher interest rates can lead to lower P/E ratios as investors demand higher returns to compensate for the increased risk. 10.2.3.3 Economic growth. Global economic growth rates can have a significant impact on a company's earnings and, consequently, its P/E ratio. Companies operating in countries with higher economic growth rates may experience higher earnings growth, leading to higher P/E ratios. Conversely, companies in countries with slower economic growth may have lower P/E ratios due to lower earnings expectations. 10.2.4 Risks and challenges of globalization in P/E ratio analysis. While globalization has brought numerous benefits to the financial world, it also presents risks and challenges when analyzing P/E ratios. Investors should be aware of the following risks and challenges. 10.2.4.1 Currency risk. Investing in foreign markets exposes investors to currency risk. Fluctuations in exchange rates can impact the value of investments and distort the P/E ratio. Investors should carefully consider the potential currency risks associated with investing in foreign companies and adjust their analysis accordingly. 10.2.4.2 Political and regulatory risks. Investing in foreign markets also exposes investors to political and regulatory risks. Changes in government policies, regulations, or geopolitical events can significantly impact a company's earnings and, consequently, its P/E ratio. Investors should assess the stability and predictability of the political and regulatory environment before making investment decisions based on P/E ratios. 10.2.4.3 Information asymmetry. Analyzing P/E ratios of foreign companies may be challenging due to information asymmetry. Obtaining accurate and reliable financial information can be more difficult for companies operating in foreign markets, especially in emerging economies. Investors should exercise caution and conduct thorough due diligence to ensure the accuracy and reliability of the financial information used in P/E ratio analysis. 10.2.5 Conclusion. Globalization has significantly influenced the analysis and interpretation of the P/E ratio. As economies become increasingly interconnected, investors need to consider the effects of globalization on companies' earnings, valuation, and P/E ratios. Understanding the impact of globalization, cross-border investments, global economic factors, and the associated risks and challenges is crucial for investors seeking to make informed investment decisions based on P/E ratio analysis in a globalized world. 10.3 Environmental, Social, and Governance (ESG) Factors in the P/E ratio. Environmental, social, and governance (ESG) factors have gained significant attention in recent years as investors increasingly recognize the importance of sustainable and responsible investing. ESG factors refer to the environmental, social, and governance practices of a company, which can have a significant impact on its long-term performance and value. In this section, we will explore how ESG factors can influence the P/E ratio and how investors can incorporate these factors into their analysis. 10.3.1 Understanding ESG factors. Before delving into the relationship between ESG factors and the P/E ratio, it is crucial to understand what these factors entail. ESG factors encompass a wide range of considerations that evaluate a company's impact on the environment, its relationships with stakeholders, and the quality of its corporate governance. Environmental factors may include a company's carbon emissions, waste management practices, and resource usage. Social factors may encompass employee relations, diversity and inclusion, and community engagement. Governance factors evaluate the company's leadership, board structure, and transparency in decision-making. 10.3.2 The impact of ESG factors on the P/E ratio. ESG factors can have a direct and indirect impact on a company's financial performance, which in turn can influence its P/E ratio. Companies that effectively manage their ESG risks and opportunities are more likely to generate sustainable long-term growth and profitability. Such companies may attract a broader investor base, including those who prioritize ESG considerations in their investment decisions. As a result, these companies may experience higher demand for their shares, leading to an increase in their stock price and subsequently their P/E ratio. On the other hand, companies with poor ESG practices may face reputational risks, regulatory challenges, and potential legal liabilities. These factors can negatively impact their financial performance and investor sentiment, leading to a decrease in their stock price and P/E ratio. Additionally, companies that fail to address ESG concerns may face higher costs related to environmental fines, employee turnover, or legal disputes, which can further impact their profitability and valuation. 10.3.3 Incorporating ESG factors into P/E ratio analysis. When analyzing the P/E ratio of a company, investors can consider ESG factors to gain a more comprehensive understanding of its long-term prospects. Here are some ways to incorporate ESG factors into P/E ratio analysis. 10.3.3.1 ESG integration. Investors can integrate ESG factors into their overall investment analysis by considering a company's ESG performance alongside traditional financial metrics. By evaluating a company's ESG practices, investors can assess its ability to manage risks, adapt to changing market dynamics, and create long-term value. This holistic approach can provide a more accurate assessment of a company's growth potential and its ability to generate sustainable earnings, which can impact its P/E ratio. 10.3.3.2 ESG ratings and scores. ESG ratings and scores provided by specialized research firms can offer valuable insights into a company's ESG performance. These ratings assess a company's ESG practices based on various criteria and provide a standardized measure of its sustainability performance. Investors can use these ratings to compare companies within an industry or across sectors and identify those with strong ESG profiles. Companies with higher ESG ratings may be more attractive to investors, potentially leading to higher P/E ratios. 10.3.3.3 Sector-specific ESG considerations. Different sectors may have unique ESG considerations that investors should take into account when analyzing the P/E ratio. For example, in the energy sector, environmental factors such as carbon emissions and renewable energy investments may be crucial. In the technology sector, social factors like data privacy and cybersecurity may be more relevant. By understanding the sector-specific ESG risks and opportunities, investors can make more informed judgments about a company's future prospects and its P/E ratio. 10.3.3.4 ESG engagement and active ownership. Investors can actively engage with companies on ESG issues and use their ownership rights to influence positive change. By participating in shareholder meetings, voting on ESG-related resolutions, and engaging in dialogue with company management, investors can encourage companies to improve their ESG practices. This engagement can lead to better risk management, enhanced reputation, and improved financial performance, potentially resulting in higher P/E ratios over time. 10.3.4 Challenges and limitations. While incorporating ESG factors into P/E ratio analysis can provide valuable insights, it is essential to acknowledge the challenges and limitations associated with this approach. ESG data can be subjective, and there is a lack of standardized reporting, making it challenging to compare companies consistently. Additionally, the impact of ESG factors on financial performance may vary across industries and over time. Investors should also be cautious of greenwashing, where companies may exaggerate their ESG efforts to attract investors. 10.3.5 Conclusion. ESG factors are increasingly recognized as important considerations in investment decision-making. By incorporating ESG factors into P/E ratio analysis, investors can gain a more comprehensive understanding of a company's long-term prospects and its ability to generate sustainable earnings. While challenges and limitations exist, the integration of ESG factors can provide valuable insights into a company's risk profile, reputation, and potential for future growth. As the focus on sustainability continues to grow, investors who consider ESG factors alongside traditional financial metrics will be better positioned to make informed investment decisions. 10.4 Artificial Intelligence and the P/E ratio. Artificial intelligence (AI) has revolutionized various industries, and the world of finance is no exception. The use of AI in financial analysis has become increasingly prevalent, and it has the potential to significantly impact the way we analyze and interpret financial data, including the P/E ratio. 10.4.1 AI and data analysis. One of the key advantages of AI is its ability to process and analyze vast amounts of data quickly and accurately. This capability is particularly valuable when it comes to analyzing financial data, including the factors that influence the P/E ratio. AI algorithms can sift through large datasets, identify patterns, and extract valuable insights that may not be immediately apparent to human analysts. By leveraging AI, financial analysts can gain a deeper understanding of the factors that affect a company's P/E ratio. AI algorithms can analyze a wide range of data, including financial statements, market trends, news articles, and social media sentiment, to identify correlations and make predictions about future P/E ratios. This can help investors make more informed decisions and identify potential investment opportunities. 10.4.2 AI and earnings forecasting. Earnings forecasting is a crucial aspect of P/E ratio analysis. Traditionally, analysts have relied on historical financial data and qualitative factors to estimate future earnings. However, AI can enhance this process by incorporating a wider range of data sources and utilizing advanced predictive models. AI algorithms can analyze a company's historical financial data, industry trends, macroeconomic indicators, and even alternative data sources such as satellite imagery or social media sentiment to generate more accurate earnings forecasts. By incorporating these forecasts into the P/E ratio analysis, investors can gain a better understanding of a company's valuation and potential future performance. 10.4.3 AI and market sentiment analysis. Market sentiment plays a significant role in determining stock prices and, consequently, the P/E ratio. AI can help analyze market sentiment by processing vast amounts of news articles, social media posts, and other textual data to gauge investor sentiment towards a particular stock or industry. Sentiment analysis algorithms can identify positive or negative sentiment in news articles and social media posts, allowing investors to assess market sentiment and its potential impact on the P/E ratio. By incorporating sentiment analysis into P/E ratio analysis, investors can gain insights into how market sentiment may influence a company's valuation. 10.4.4 AI and pattern recognition. AI algorithms excel at pattern recognition, which can be valuable in analyzing the P/E ratio. By analyzing historical P/E ratios and other financial data, AI algorithms can identify patterns and trends that may not be immediately apparent to human analysts. For example, AI algorithms can identify cyclical patterns in P/E ratios, helping investors understand how a company's valuation may fluctuate over time. Additionally, AI can identify anomalies or outliers in P/E ratios, alerting investors to potential investment opportunities or risks. 10.4.5 AI and portfolio optimization. AI can also play a crucial role in portfolio optimization by incorporating the P/E ratio into the investment decision-making process. By analyzing a wide range of financial data, including P/E ratios, AI algorithms can identify optimal portfolio allocations based on an investor's risk tolerance, investment goals, and market conditions. AI-powered portfolio optimization models can consider various factors, such as diversification, risk-adjusted returns, and correlations between different assets. By incorporating the P/E ratio into these models, investors can make more informed decisions about their portfolio allocations and potentially improve their investment performance. 10.4.6 Limitations and challenges. While AI has the potential to enhance P/E ratio analysis, it is not without its limitations and challenges. AI algorithms rely on historical data to make predictions, and their accuracy is dependent on the quality and relevance of the data used. Additionally, AI algorithms may struggle to interpret qualitative factors or unexpected events that may impact a company's P/E ratio. Furthermore, the use of AI in financial analysis raises ethical considerations, such as data privacy and algorithmic bias. It is essential to ensure that AI algorithms are transparent, fair, and comply with regulatory requirements to maintain investor trust and confidence. Conclusion. Artificial intelligence has the potential to revolutionize P/E ratio analysis by enhancing data analysis, earnings forecasting, market sentiment analysis, pattern recognition, and portfolio optimization. By leveraging AI algorithms, investors can gain deeper insights into the factors that influence the P/E ratio and make more informed investment decisions. However, it is crucial to recognize the limitations and challenges associated with AI and ensure its responsible and ethical use in financial analysis. 11. Case Studies. 11.1 Case Study 1. In this case study, we will analyze the P/E ratio of Company a leading technology company in the software industry. The purpose of this case study is to understand how the P/E ratio can be used to evaluate the investment potential of a company and make informed investment decisions. 11.1.1 Company Background. Company A is a well-established software company that specializes in developing innovative software solutions for businesses. It has a strong market presence and a track record of consistent revenue growth. The company operates in a highly competitive industry and has a reputation for delivering high-quality products and services. 11.1.2 P/E ratio analysis. To begin our analysis, let's calculate the P/E ratio of Company A. The P/E ratio is calculated by dividing the market price per share by the earnings per share (EPS). The EPS is obtained by dividing the company's net income by the number of outstanding shares. Let's assume that Company A's current market price per share is $100 and its EPS is $5. Therefore, the P/E ratio can be calculated as follows. P/E ratio equals market price per share, earnings per share equals $100 for $5 equals 20. The P/E ratio of Company A is 20, indicating that investors are willing to pay 20 times the company's earnings for each share of stock. This ratio provides valuable insights into the market's perception of the company's future earnings potential and growth prospects. 11.1.3 Comparison with industry peers. To gain a better understanding of Company A's valuation, it is important to compare its P/E ratio with its industry peers. By comparing the P/E ratios of similar companies within the software industry, we can assess whether Company A is overvalued, undervalued, or trading at a fair value. Let's assume that the average P/E ratio of Company A's industry peers is 25. Comparing this with Company A's P/E ratio of 20, we can conclude that Company A is trading at a relatively lower valuation compared to its peers. This suggests that the market may not fully recognize the company's growth potential, making it an attractive investment opportunity. 11.1.4 Historical P/E ratio analysis. Analyzing the historical P/E ratio of Company A can provide further insights into its valuation and growth prospects. By examining the trend of the P/E ratio over time, we can identify any significant changes or patterns that may impact the investment decision. Let's assume that Company A's historical P/E ratio over the past 5 years has ranged from 15 to 25. This indicates that the market's perception of the company's earnings potential has varied over time. By comparing the current P/E ratio of 20 with the historical range, we can determine whether the company is currently undervalued, overvalued, or trading at a fair value. 11.1.5 Future Outlook. In addition to historical analysis, it is crucial to consider the future outlook of Company A when evaluating its P/E ratio. Factors such as anticipated earnings growth, market conditions, and industry trends can significantly impact the company's valuation. Let's assume that Company A is expected to experience strong earnings growth in the coming years due to its innovative product pipeline and expanding customer base. This positive outlook suggests that the company's P/E ratio of the 20th of May not fully reflect its future earnings potential. As a result, investors may consider Company A as an attractive investment opportunity with the potential for capital appreciation. 11.1.6 Risks and Limitations. While the P/E ratio provides valuable insights into a company's valuation, it is important to acknowledge its limitations and consider other factors when making investment decisions. The P/E ratio does not take into account factors such as debt levels, cash flow, and industry-specific dynamics, which can significantly impact a company's financial health and growth prospects. Investors should also be cautious of relying solely on the P/E ratio when evaluating a company's investment potential. It is essential to conduct a comprehensive analysis that incorporates other financial ratios, qualitative factors, and industry-specific considerations to make well-informed investment decisions. 11.1.7 Conclusion. In this case study, we analyze the P/E ratio of Company a leading technology company in the software industry. By calculating the P/E ratio, comparing it with industry peers, and considering historical trends and future outlook, we gained valuable insights into the company's valuation and investment potential. The P/E ratio of 20 indicated that Company A was trading at a relatively lower valuation compared to its industry peers. This suggested that the market may not fully recognize the company's growth potential, making it an attractive investment opportunity. However, it is important to consider the risks and limitations of the P/E ratio and conduct a comprehensive analysis before making investment decisions. By incorporating other financial ratios, qualitative factors, and industry-specific considerations, investors can make well-informed decisions and maximize their investment returns. 11.2 Case Study 2. In this case study, we will analyze the successful application of the P/E ratio in evaluating the investment potential of Company B by examining the company's financials and market performance. We can gain insights into how the P/E ratio can be used as a valuable tool for investors. 11.2.1 Company background. Company B is a well-established technology company that specializes in the development and manufacturing of consumer electronics. It has a strong presence in the global market and is known for its innovative products and cutting-edge technology. The company has experienced steady growth over the years and has a solid track record of delivering strong financial performance. 11.2.2 P/E ratio analysis. To begin our analysis, let's calculate the P/E ratio for Company B. We will use the formula P/E ratio equals market price per share, earnings per share, EPS. By examining the company's financial statements, we find that the market price per share is $50, and the earnings per share EPS is $5. Therefore, the P/E ratio for Company B is P/E ratio equals $50 for $5 equals 10. 11.2.3 Comparison with industry peers. Next, let's compare Company B's P/E ratio with its industry peers to gain a better understanding of its valuation. We find that the average P/E ratio for companies in the technology sector is 15. This indicates that Company B's P/E ratio of 10 is relatively lower than the industry average. A lower P/E ratio suggests that the market has a more conservative outlook on the company's future earnings potential. It could indicate that investors have concerns about the company's growth prospects or perceive higher risks associated with its business model. However, it could also present an opportunity for value investors who believe that the market has undervalued the company. 11.2.4 Historical P/E ratio trends. To further assess the investment potential of Company B, let's examine its historical P/E ratio trends. By analyzing the company's P/E ratio over the past 5 years, we can identify any significant changes or patterns. Upon reviewing the data, we observe that Company B's P/E ratio has been consistently lower than the industry average throughout the years. This suggests that the market has consistently undervalued the company relative to its peers. However, it is essential to consider the reasons behind this undervaluation, such as the company's growth prospects, financial performance, and market conditions. 11.2.5 Earnings growth and P/E ratio. One crucial factor to consider when analyzing the P/E ratio is the company's earnings growth. A company with a higher earnings growth rate is likely to command a higher P/E ratio, indicating market optimism about its future prospects. In the case of Company B, we find that it has consistently delivered strong earnings growth over the past few years. This growth can be attributed to its successful product launches, expanding market share, and effective cost management. The company's ability to generate consistent earnings growth supports the argument that the market has undervalued its stock. 11.2.6 Market sentiment and P/E ratio. Market sentiment plays a significant role in determining a company's P/E ratio. Positive market sentiment can drive up the P/E ratio, while negative sentiment can lead to a lower P/E ratio. In the case of Company B, we find that the market sentiment has been relatively positive due to its strong brand reputation, innovative products, and consistent financial performance. This positive sentiment has contributed to the company's higher P/E ratio compared to its industry peers. 11.2.7 Future outlook. Based on our analysis of Company B's P/E ratio, historical trends, earnings growth, and market sentiment, we can conclude that the company has strong investment potential. The lower P/E ratio compared to its industry peers suggests that the market has undervalued the company, presenting an opportunity for investors. However, it is crucial to consider other factors such as the company's competitive landscape, industry trends, and potential risks before making any investment decisions. Conducting a comprehensive analysis that incorporates multiple valuation metrics and qualitative factors will provide a more holistic view of the company's investment potential. By leveraging the power of the P/E ratio and conducting thorough analysis, investors can identify undervalued companies and make informed investment decisions. Company B serves as an excellent example of how the P/E ratio can be used successfully to evaluate investment opportunities and generate favorable returns. 11.3 Case Study 3. In this case study, we will analyze the successful application of the P/E ratio in evaluating the investment potential of Company C. Company C operates in the technology sector and has shown consistent growth over the past few years. By examining the P/E ratio and other relevant factors, we can gain insights into the company's financial health and make informed investment decisions. 11.3.1 Company Overview. Company C is a leading technology company that specializes in developing innovative software solutions for businesses. It has a strong market presence and a solid track record of delivering high-quality products. The company operates globally and has a diverse customer base across various industries. 11.3.2 Historical P/E ratio analysis. To begin our analysis, let's examine the historical P/E ratio of Company C over the past 5 years. By comparing the P/E ratio to the industry average and the company's historical performance, we can assess its valuation and growth potential. Year P/E ratio 2016 20.52017 22.32018 25.12019 28.62020 30.2. From the data, we can observe a consistent upward trend in the P/E ratio of Company C. This indicates that investors are willing to pay a higher price for each dollar of earnings generated by the company. The increasing P/E ratio suggests growing market confidence in the company's future prospects. 11.3.3 Earnings growth and P/E ratio. Next, let's analyze the relationship between earnings growth and the P/E ratio of Company C. By examining the company's financial statements and earnings reports, we can gain insights into its profitability and potential for future growth. Over the past 5 years, Company C has consistently reported strong earnings growth, with an average annual growth rate of 15%. This robust growth is driven by the company's ability to innovate and capture new market opportunities. As a result, investors have shown increased interest in the company, leading to a higher P/E ratio. The relationship between earnings growth and the P/E ratio is crucial in determining the company's valuation. A high P/E ratio coupled with strong earnings growth suggests that investors have high expectations for future earnings. However, it is essential to consider other factors such as industry trends, competition, and market conditions to make a comprehensive assessment. 11.3.4 Comparative analysis. To gain a better understanding of Company C's valuation, let's compare its P/E ratio to other companies in the technology sector. This comparative analysis will help us assess whether the company is overvalued or undervalued relative to its peers. After conducting the analysis, we find that Company C's P/E ratio is slightly higher than the industry average. This indicates that investors are willing to pay a premium for the company's earnings compared to its competitors. However, it is crucial to consider other factors such as growth prospects, market share, and competitive advantages to make a more accurate assessment of the company's valuation. 11.3.5 Market sentiment and P/E ratio. Market sentiment plays a significant role in determining the P/E ratio of a company. Positive market sentiment can drive up the P/E ratio, while negative sentiment can lead to a decline. Let's examine the impact of market sentiment on Company C's P/E ratio. During the period under analysis, the overall market sentiment towards the technology sector has been positive. This positive sentiment is driven by factors such as technological advancements, increasing demand for software solutions, and favorable economic conditions. As a result, investors have shown a higher willingness to pay a premium for technology stocks, including Company C, leading to an increase in its P/E ratio. 11.3.6 Future outlook. Based on our analysis, Company C has demonstrated strong financial performance, consistent earnings growth, and a positive market sentiment. These factors indicate a favorable investment opportunity. However, it is essential to consider potential risks and uncertainties, such as changes in market dynamics, technological disruptions, and competitive pressures. Investors should also monitor the company's ability to sustain its growth trajectory and adapt to evolving market conditions. Conducting regular evaluations of the P/E ratio and other relevant financial metrics will help investors make informed decisions and adjust their investment strategies accordingly. In conclusion, the successful application of the P/E ratio in analyzing Company C has provided valuable insights into its financial health and growth potential. By considering historical trends, earnings growth, comparative analysis, market sentiment, and future outlook, investors can make informed investment decisions. However, it is crucial to conduct comprehensive research and consider other factors before making any investment choices. 11.4 Lessons learned from successful P/E ratio analysis. In the previous chapters, we have explored the various aspects of the P/E ratio, its calculation, limitations, historical analysis, valuation methods, market conditions, investment decisions, common pitfalls, advanced analysis techniques, and its role in different investment strategies. Now, let's delve into the lessons learned from successful P/E ratio analysis. 11.4.1 Understanding the company's business model. One of the key lessons learned from successful P/E ratio analysis is the importance of understanding the company's business model. The P/E ratio alone cannot provide a complete picture of a company's value. It is crucial to analyze the underlying factors that drive the earnings and growth potential of the company. By understanding the company's business model, its competitive advantages, and its industry dynamics, investors can make more informed decisions about the appropriate P/E ratio to use for valuation. 11.4.2 Comparing P/E ratios across industries. Successful P/E ratio analysis also involves comparing P/E ratios across industries. Different industries have varying growth rates, risk profiles, and earnings potential. By comparing a company's P/E ratio to its industry peers, investors can gain insights into whether the company is overvalued or undervalued relative to its competitors. This analysis helps investors identify potential investment opportunities and avoid overpaying for stocks. 11.4.3 Analyzing P/E ratio trends over time. Another valuable lesson from successful P/E ratio analysis is the importance of analyzing P/E ratio trends over time. The P/E ratio is not a static metric and can fluctuate based on market conditions, investor sentiment, and company-specific factors. By analyzing the historical trends of a company's P/E ratio, investors can identify patterns and understand whether the current P/E ratio is high or low compared to its historical average. This analysis provides valuable insights into the market's perception of the company's future earnings potential. 11.4.4 Considering earnings quality and consistency. Successful P/E ratio analysis also involves considering the quality and consistency of a company's earnings. The P/E ratio is based on earnings, and if the earnings are volatile or subject to manipulation, the P/E ratio may not accurately reflect the company's value. Investors should carefully analyze the company's financial statements, accounting practices, and management's track record to ensure the reliability of the earnings. By considering earnings quality and consistency, investors can make more accurate assessments of a company's valuation using the P/E ratio. 11.4.5 Incorporating market sentiment and economic factors. Market sentiment and economic factors play a significant role in P/E ratio analysis. Successful investors understand the impact of market cycles, economic conditions, and investor sentiment on the P/E ratio. During periods of optimism, P/E ratios tend to be higher, reflecting higher expectations for future earnings growth. Conversely, during periods of pessimism, P/E ratios may be lower, indicating lower expectations for future earnings. By incorporating market sentiment and economic factors into their analysis, investors can better interpret the P/E ratio and make more informed investment decisions. 11.4.6 Using the P/E ratio in conjunction with other valuation metrics. Successful P/E ratio analysis also involves using the P/E ratio in conjunction with other valuation metrics. While the P/E ratio provides insights into a company's earnings multiple, it is essential to consider other factors such as price-to-sales ratio, price-to-book ratio, and discounted cash flow analysis. By using multiple valuation metrics, investors can gain a more comprehensive understanding of a company's valuation and make more accurate investment decisions. 11.4.7 Regularly monitoring and updating P/E ratio analysis. Lastly, successful P/E ratio analysis requires regular monitoring and updating. The P/E ratio is not a one-time analysis but an ongoing process. Investors should continuously monitor the company's financial performance, industry dynamics, and market conditions to ensure the accuracy of their P/E ratio analysis. By staying informed and updating their analysis regularly, investors can adapt to changing circumstances and make timely investment decisions. In conclusion, successful P/E ratio analysis involves understanding the company's business model, comparing P/E ratios across industries, analyzing P/E ratio trends over time, considering earnings quality and consistency, incorporating market sentiment and economic factors, using the P/E ratio in conjunction with other valuation metrics, and regularly monitoring and updating the analysis. By applying these lessons, investors can enhance their ability to evaluate companies, identify investment opportunities, and make informed decisions based on the P/E ratio. 12. Conclusion and future outlook. 12.1 Summary of key findings. Throughout this book, we have explored the concept of the price-to-earnings P/E ratio and its significance in investment analysis. In this final section, we will summarize the key findings and insights gained from our exploration of the P/E ratio. The P/E ratio is a fundamental valuation metric used by investors to assess the relative value of a company's stock. It is calculated by dividing the market price per share by the earnings per share (EPS). The ratio provides a measure of how much investors are willing to pay for each dollar of earnings generated by the company. One of the primary findings from our analysis is that the P/E ratio can vary significantly across different industries and sectors. This variation is driven by factors such as growth prospects, risk profiles, and market dynamics specific to each industry. Therefore, it is crucial to consider industry norms and benchmarks when interpreting the P/E ratio of a company. Another key finding is that the P/E ratio is not a standalone indicator of a company's value. It should be used in conjunction with other financial metrics and qualitative factors to form a comprehensive investment thesis. Over-reliance on the P/E ratio alone can lead to misleading conclusions and investment mistakes. We have also discovered that the P/E ratio is influenced by various economic factors and market conditions. In bull markets, the P/E ratio tends to be higher as investors exhibit optimism and are willing to pay a premium for future earnings growth. Conversely, in bear markets, the P/E ratio tends to be lower as investors become more risk-averse and demand a higher margin of safety. Furthermore, our analysis has revealed that the P/E ratio can be used in different investment strategies. Value investors often seek companies with low P/E ratios, indicating that the stock may be undervalued relative to its earnings. On the other hand, growth investors may be willing to pay a higher P/E ratio for companies with strong growth prospects. We have also explored the limitations and pitfalls of P/E ratio analysis. Ignoring industry norms, inconsistent earnings quality, and misinterpreting P/E ratio changes are common mistakes that investors should avoid. It is essential to consider the broader context and conduct thorough due diligence when using the P/E ratio as a valuation tool. Looking ahead, we anticipate that technological advancements, globalization, and environmental, social, and governance (ESG) factors will have a significant impact on P/E ratio analysis. As technology continues to reshape industries, companies with innovative business models and disruptive technologies may command higher P/E ratios. Additionally, the growing emphasis on ESG factors may influence investors' perception of a company's long-term sustainability and affect its P/E ratio. In conclusion, the P/E ratio is a valuable tool for investors to assess the relative value of a company's stock. However, it should be used in conjunction with other financial metrics and qualitative analysis. Understanding industry norms, economic factors, and market conditions is crucial for accurate interpretation. By considering these factors and avoiding common pitfalls, investors can leverage the power of the P/E ratio to make informed investment decisions. As the investment landscape evolves, it is essential to stay updated on emerging trends and adapt P/E ratio analysis accordingly. 12.2 Implications for investors. The P/E ratio, also known as the price-to-earnings ratio, is a fundamental tool used by investors to assess the value of a company's stock. It provides valuable insights into the market's perception of a company's earnings potential and growth prospects. Understanding the implications of the P/E ratio can help investors make informed investment decisions and navigate the complex world of stock market investing. 12.2.1 Evaluating stock valuation. One of the primary implications of the P/E ratio for investors is its role in evaluating stock valuation. A high P/E ratio suggests that the market has high expectations for a company's future earnings growth, while a low P/E ratio may indicate undervaluation or pessimism about a company's prospects. By comparing the P/E ratio of a company to its industry peers or historical averages, investors can gain insights into whether a stock is overvalued or undervalued. 12.2.2 Assessing growth potential. The P/E ratio can also provide valuable insights into a company's growth potential. A high P/E ratio indicates that investors are willing to pay a premium for the company's earnings growth, suggesting that the company has strong growth prospects. On the other hand, a low P/E ratio may indicate that the market has doubts about the company's ability to generate future earnings growth. By analyzing the P/E ratio in conjunction with other financial metrics and industry trends, investors can assess a company's growth potential and make informed investment decisions. 12.2.3 Comparing companies and industries. Another implication of the P/E ratio for investors is its usefulness in comparing companies and industries. By comparing the P/E ratios of different companies within the same industry, investors can identify companies that are relatively undervalued or overvalued compared to their peers. Additionally, comparing the P/E ratios of companies across different industries can provide insights into the relative attractiveness of different sectors. However, it is important to consider other factors such as growth prospects, competitive landscape, and industry dynamics when making investment decisions based on P/E ratio comparisons. 12.2.4 Identifying market sentiment. The P/E ratio can also be used as a gauge of market sentiment. In bull markets, when investor optimism is high, P/E ratios tend to be elevated as investors are willing to pay higher prices for stocks. Conversely, in bear markets or during periods of market pessimism, P/E ratios tend to be lower as investors demand a higher margin of safety. By analyzing the P/E ratio in the context of broader market conditions, investors can gain insights into market sentiment and adjust their investment strategies accordingly. 12.2.5 Managing risk. The P/E ratio can play a crucial role in managing investment risk. A high P/E ratio implies higher expectations and greater risk of disappointment if a company fails to meet those expectations. Conversely, a low P/E ratio may indicate a lower level of risk as the market has already priced in lower growth expectations. By considering the P/E ratio alongside other risk factors such as industry dynamics, competitive landscape, and financial stability, investors can make more informed decisions and manage their risk exposure effectively. 12.2.6 Long-term investment strategy. For long-term investors, the P/E ratio can provide insights into the potential returns of an investment over time. A low P/E ratio may suggest that a stock is undervalued and has the potential for future price appreciation. However, it is important to consider other factors such as the company's competitive advantage, management quality, and industry trends when making long-term investment decisions. The P/E ratio should be used as one tool among many in a comprehensive investment analysis. 12.2.7 Market efficiency and anomalies. The P/E ratio can also shed light on market efficiency and anomalies. Efficient market hypothesis suggests that stock prices reflect all available information, including the P/E ratio. However, anomalies can occur when certain stocks or sectors exhibit P/E ratios that deviate significantly from their fundamental values. By identifying such anomalies, investors can potentially capitalize on mispriced stocks and generate above-average returns. However, it is important to conduct thorough research and analysis to differentiate between genuine anomalies and temporary market inefficiencies. 12.2.8 Investor behavior and psychological biases. Investor behavior and psychological biases can significantly impact the interpretation and use of the P/E ratio. Behavioral biases such as herd mentality, overconfidence, and anchoring can lead to irrational investment decisions based solely on the P/E ratio. It is crucial for investors to be aware of these biases and approach P/E ratio analysis with a rational and objective mindset. By combining the P/E ratio with other financial metrics, qualitative analysis, and a disciplined investment approach, investors can mitigate the impact of behavioral biases and make more informed decisions. In conclusion, the P/E ratio has significant implications for investors. It provides insights into stock valuation, growth potential, market sentiment, and risk management. By analyzing the P/E ratio in conjunction with other financial metrics and industry trends, investors can make informed investment decisions and navigate the complexities of the stock market. However, it is important to consider the limitations of the P/E ratio and conduct comprehensive research and analysis before making investment decisions solely based on this ratio. 12.3 Future Directions in P/E ratio analysis. As we conclude our exploration of the P/E ratio and its various applications, it is important to consider the future directions in P/E ratio analysis. The financial landscape is constantly evolving, and new trends and developments can significantly impact the way we interpret and utilize the P/E ratio. In this section, we will discuss some potential future directions in P/E ratio analysis and how they may shape investment strategies and decision-making processes. 12.3.1 Incorporating non-financial factors. Traditionally, the P/E ratio has focused primarily on financial metrics such as earnings and stock prices. However, there is a growing recognition that non-financial factors, such as environmental, social, and governance (ESG) considerations, can have a significant impact on a company's long-term performance and valuation. Future directions in P/E ratio analysis may involve incorporating ESG factors into the analysis to provide a more comprehensive assessment of a company's value. This could involve evaluating a company's sustainability practices, social impact, and corporate governance structure alongside its financial performance. 12.3.2 Integration of artificial intelligence. The rise of artificial intelligence (AI) has revolutionized many industries, and the field of finance is no exception. AI-powered algorithms and machine learning techniques have the potential to enhance P/E ratio analysis by analyzing vast amounts of data and identifying patterns and trends that may not be immediately apparent to human analysts. Future directions in P/E ratio analysis may involve the integration of AI tools to automate the process of analyzing financial statements, identifying outliers, and generating more accurate and timely P/E ratio assessments. 12.3.3 Expansion of industry-specific P/E ratios. While the P/E ratio is a widely used valuation metric, it is important to recognize that different industries have unique characteristics and dynamics that can influence their P/E ratios. Future directions in P/E ratio analysis may involve the development of industry-specific P/E ratios that take into account the specific factors that drive valuation within each sector. This could provide investors with a more accurate benchmark for comparing companies within the same industry and enable more informed investment decisions. 12.3.4 Integration of big data analytics. The availability of vast amounts of data has opened up new possibilities for investment analysis. Future directions in P/E ratio analysis may involve the integration of big data analytics to enhance the accuracy and reliability of P/E ratio assessments. By leveraging data from various sources, including social media sentiment, consumer behavior, and macroeconomic indicators, analysts can gain deeper insights into market trends and investor sentiment, which can in turn impact a company's P/E ratio. This integration of big data analytics could provide a more holistic view of a company's valuation and help investors make more informed decisions. 12.3.5 Dynamic P/E ratio models. The traditional P/E ratio is a static measure that provides a snapshot of a company's valuation at a specific point in time. However, future directions in P/E ratio analysis may involve the development of dynamic P/E ratio models that take into account the changing nature of businesses and markets. These models could incorporate factors such as earnings growth rates, market volatility, and economic conditions to provide a more nuanced and real-time assessment of a company's valuation. By considering the dynamic nature of the market, investors can make more accurate predictions and adjust their investment strategies accordingly. 12.3.6 Enhanced visualization and reporting. In an era of information overload, effective visualization and reporting of financial data are crucial for investors to make sense of complex information. Future directions in P/E ratio analysis may involve the development of enhanced visualization tools and reporting frameworks that present P/E ratio data in a more intuitive and user-friendly manner. This could include interactive charts, graphs, and dashboards that allow investors to explore and analyze P/E ratio trends and patterns more effectively. In conclusion, the future of P/E ratio analysis holds exciting possibilities. Incorporating non-financial factors, integrating artificial intelligence, expanding industry-specific P/E ratios, leveraging big data analytics, developing dynamic P/E ratio models, and enhancing visualization and reporting are some of the potential future directions in P/E ratio analysis. By embracing these advancements, investors can gain deeper insights into company valuations and make more informed investment decisions. As the financial landscape continues to evolve, it is essential for investors to stay abreast of these future directions in P/E ratio analysis to maximize their investment potential. 12.4 Final thoughts. In this book, we have explored the power of the P/E ratio and its significance in investment analysis. The P/E ratio is a widely used financial metric that provides valuable insights into the valuation of a company's stock. Throughout the chapters, we have discussed various aspects of the P/E ratio, including its calculation, historical analysis, valuation methods, market conditions, investment decisions, common pitfalls, advanced analysis techniques, and its role in different investment strategies. We have also examined the relationship between the P/E ratio and market efficiency, as well as future trends in P/E ratio analysis. The P/E ratio is a simple yet powerful tool that allows investors to assess the relative value of a stock by comparing its price to its earnings. It provides a snapshot of how much investors are willing to pay for each dollar of earnings generated by a company. A high P/E ratio suggests that investors have high expectations for future earnings growth, while a low P/E ratio may indicate undervaluation or lower growth prospects. One of the key takeaways from our exploration of the P/E ratio is the importance of considering industry norms when analyzing a company's P/E ratio. Each industry has its own unique characteristics and growth prospects, which can significantly impact the appropriate P/E ratio range. Ignoring industry norms can lead to misleading conclusions about a company's valuation. Another pitfall to avoid is over-reliance on the P/E ratio as the sole indicator of a company's value. While the P/E ratio provides valuable insights, it should be used in conjunction with other financial metrics and qualitative analysis to form a comprehensive investment thesis. Inconsistent earnings quality and misinterpreting changes in the P/E ratio can also lead to erroneous conclusions. We have also discussed advanced analysis techniques that leverage the P/E ratio to evaluate different types of stocks, such as growth stocks, value stocks, cyclical stocks, and defensive stocks. Each type of stock requires a nuanced approach to P/E ratio analysis, considering factors such as earnings growth, market conditions, and industry dynamics. Furthermore, we have explored how the P/E ratio can be incorporated into different investment strategies, including value investing, growth investing, dividend investing, and momentum investing. The P/E ratio can serve as a valuable tool in each of these strategies, helping investors identify undervalued stocks, assess growth potential, evaluate dividend yield, and gauge market sentiment. Our examination of the P/E ratio's relationship with market efficiency has shed light on the efficient market hypothesis and market anomalies. While the efficient market hypothesis suggests that stock prices fully reflect all available information, market anomalies indicate instances where the P/E ratio can be used to identify mispriced stocks. Understanding these anomalies and behavioral biases can provide investors with an edge in their decision-making process. Looking towards the future, we have explored the potential impact of technological advancements, globalization, environmental, social, and governance (ESG) factors, and artificial intelligence on P/E ratio analysis. These factors are likely to shape the future of investment analysis and may introduce new dimensions to the interpretation and application of the P/E ratio. In conclusion, the P/E ratio is a versatile and powerful tool that can provide valuable insights into a company's valuation and investment potential. However, it is crucial to use the P/E ratio in conjunction with other financial metrics and qualitative analysis to form a comprehensive investment thesis. By understanding the limitations, pitfalls, and advanced techniques associated with the P/E ratio, investors can make more informed investment decisions and navigate the dynamic landscape of the stock market with confidence. The P/E ratio will continue to be a fundamental tool in the arsenal of investors, helping them uncover opportunities and assess the relative value of stocks in an ever-changing market environment.